It's a really tricky time for the market because things are slowing.
Growth continues to slow, and that continues to pressure profits.
There's just a lot of great news priced into great companies right now.
If the consensus is talking about some sort of cliff dive moment in the second quarter, that's not happening.
This is ultimately really going to be, I think, a defining earnings season for winners and losers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures on the S&P 500 down about 0.2%. Wrapping up the bank earnings with First Republic a little bit later on this afternoon. Looking ahead and pushing forward to tech results, Tom, reporting later this week.
This is key, and I love the Dan Ives comment there, the winners and losers. And I think when we get to Apple May 4th, we're going to have an idea of the winners and the losers. To start strong this week with Margie Patel with her tech ownership is pretty cool. I think tech is frankly as important as the banks. Looking forward to that conversation, Tom. Tomorrow we get Google, Microsoft onto Wednesday, Meta, Thursday, Amazon. Can we just start this morning with LVMH? LVMH over in Europe, big red headline crossing a Bloomberg moments ago. LVMH market value hitting $500 billion, the first for a European listed company. Chris Bryant owns a story this morning with Bloomberg News, and he reports on the rate of change there in the new Europe. And this goes back, John, to the IMF meetings and talking to the former Prime Minister of Italy, Gentiloni, about eurosclerosis. And maybe the eurosclerosis in some way is finally gone. And consumer boom time over in China, making a comeback, helping out this name as well. We caught up with Patrick Armstrong on Friday of Plurimi Wealth. Lisa, this quote from him: if you feel safe owning it, it's probably too expensive. What did he sell in the last quarter? He sold LVMH after some big gains year to date. And looking now at Hermes as a potential add-on to that, this idea of when do you consolidate your gains? When have we priced in fully the China recovery, the consumer spending? Is that really what we're seeing in terms of the unexpected boom in certain European areas? Because they are concentrated in the luxury sectors, and we cannot ignore that. We'll return to that story in just a moment. I want to pick up on this as well. We got some numbers on the panic of Q1 for Credit Suisse. And these are the numbers. Credit Suisse saw $69 billion in outflows in Q1, ultimately culminating in the deal that was done with UBS. So what's interesting about this is the Swiss bank, according to our reporting, lost more than 200 billion Swiss of customer deposits over 6 months. So 4Q22 was that much worse than 1Q 2023. I would have expected those numbers for Q1 23 to be a whole lot worse than they turn out to be. I wonder if they keep going here. I mean, the whole thing is a triage they have to do. And again, and particularly for our American audience waking up this morning, this is incredibly a Swiss domestic issue. We have to look at it within the prism of domestic politics and emotion among the cantons of Switzerland. And my main question was, what does this mean in terms of how difficult or less difficult will it be for UBS? And I'm looking at UBS shares up about 2% after this earnings report. To me, the difficulty was, I think about 250 managers, money managers had left, so that they were losing talent. And this is one of the key issues. How do you keep the talent while also having the ambiguity of what a 4-year potentially process could mean of acquiring Credit Suisse? On a McKinsey basis, did they get this done quickly, or is this one of these 3-year grand plans? I can't imagine they can do this, John, over 3 years. They're going to have to grind through a ton of questions anyway. They've signaled it could take 3 to 4 years, up to 4 years, something like that's the guidance. But to go back to the numbers again, given the way the regulators behaved that weekend, how that news conference went, if you just listened to that news conference and went back over it all over again, and then you were asked to guess what the outflows were, I'm not sure, Tom, you would have come up with 69 billion. I would have come up with something much, much worse than that number. I would have thought Q1 was that much worse than Q4. I would agree. I just don't know. I wonder what forward the wealth management assets look like for UBS, and I think that's open to question as well. Well, first thing Lisa said this morning, look at UBS stock. Positive. So maybe that tells you something, up about 2%. Let's push forward and get through the price action. The equity market is negative on the S&P by 0.2%. Last week, an absolute snoozer. On the week, down about 0.1% on the S&P 500. So far this month, Tom, I think we've had a move of positive 0.6% on the S&P. On radio, I'm squeezing my fingers together. What you do is you look at the moving averages. In my case, John, exponential moving averages. There are 3 of them. And what happens when you snooze is they conform
conflate together in a point. We're not at a perfect point now, but it does speak to the quiet that's out there. I think it's based off earnings as well. Mike Wilson's right about that at Morgan Stanley.
The bond market has not been a snooze. The 10-year yield lower by about 3 basis points. The 10-year this morning, 3.54. Lisa, the 2-year north of 4%, still coming in a couple of basis points. Let's call this 4.16.
When you talk about the very narrow ranges on equities, perhaps not in the bond market, it goes to the uncertainty of whether we're accelerating or decelerating when it comes to the economy. And different sectors have different images. U.S. Chicago Fed National Index for the month of March coming out at 8:30, and U.S. Dallas Fed manufacturing activity for April. I'm very curious to see whether they reflect the unexpected pop that we saw in manufacturing indexes last week, which I thought was interesting. Are we seeing a turn after the recession in this one particular area that was really driving the sort of optimism of a disinflationary kind of momentum? Today, we also get, and this is really going to be interesting, Tom, you talk about the VIX index all the time. Look at how low it is. This doesn't really raise concerns. Well, some people say it's just not accurate. And so the CBOE Global Markets is launching this new one-day version of this particular index that's supposed to more accurately reflect the volatility in day-to-day trading. This perhaps will give some indication of why there has been this massive divergence between the VIX index and the MOVE index, which tracks bond market volatility. This has been one of the biggest questions. Why are we not seeing that if so many people are so bearish? And after market, we are getting First Republic Bank earnings, and this comes after we've seen a slew of regional bank earnings that have not lifted the KBW Regional Bank Index. And, John, I think that's interesting because we have gotten a lot of news. It hasn't been terrible. We haven't gotten catastrophic surprises, and yet hasn't been enough to resurrect valuations that have been severely damaged over the past couple of months.
It's a really good point. Lisa, thanks for that. Joining us now, Margie Patel of Allspring Global Investments. Margie, wonderful to catch up with you. Tom mentioned this conversation at the very start of the programme, pushing forward to tech earnings later this week. Margie, you still hold a lot of tech. Can you walk us through where you're taking that equity exposure at the moment, going into results later this week?
Well, this is going to be a huge week for stocks. A huge number of companies are reporting. We still like the tech sector because certainly the understanding that there's a lot of inventory to be worked off, that we may have to wait for the second half of the year to see a turn in demand is well understood. And the stocks have anticipated that. Most have performed really well. So the question is, can they have decent results and the markets really go down because of that? We think we'd rather ride that out and say these companies have long-term growth, they have good positions in their industry, strong balance sheets to withstand, even if we do have a deep recession.
Margie, I look at tech, and the rep here that so many people are afraid of is tech conservative. How do you determine a measured conservative cash flow from a high flyer that could be trouble? Well, I don't really know about the high flyers. I like to avoid the high flyers that might have trouble. But just looking at companies that have improved their market position, who are technological leaders, that have a lot of cash on their balance sheet, and also that pay a dividend. A lot of tech stocks pay a dividend. Give us a name. We think that's a good sign. Margie, give us a name. Come on, no one's watching. Well, we think Broadcom is a good stock because it's diversified and a dividend.
All right. Well, going forward, we talk about when to know when to cash out. Margie, we have seen a huge run in some of the big tech names that are profitable. They've really been, frankly, the backbone of any gains that we've gotten so far this year. When do you say that's enough?
Well, I think that's true, but on a relative basis, we really don't know how deep of a economic correction we're going to have. Will it be mild? Will it be more severe? And so tech prices may come down because PEs have expanded. However, we don't know if other sectors will have very disappointing earnings if we have a big recession. So that's kind of the push and pull in the market of where you want to be positioned.
Have you been surprised at the market's reaction to some of these earnings, Margie? And I ask because people have been waiting for the earnings recession, and in certain areas, it's come, and markets don't care. I mean, what do you make of that?
No. Well, so far this earnings season, which is really only about 20% or so, the results have been surprisingly good. And the market was really looking for signs that companies would tone down their earnings expectation, the quarter would be disappointing, and it hasn't been. So we're still waiting for that correction we haven't seen.
We have seen a correction, though, in net interest margins at the smaller banks. Lisa talked about this through most of last week as we got a drip feed of news from small and medium-sized lenders in the United States. Margie, just in terms of taking a step back and trying to understand the broader economy, what is the relationship between declining net interest margins and bank lending to the rest of the economy?
Well, I think everything rolls back to the Fed and their super aggressive policy last year that really put the banks kind of in a box on net interest margin. So we think we have to see the yield curve get not so inverted as a big thing, and see a little more stability from the Fed. And we think we've already seen, even before the distress we saw in the first quarter, bank lending standards were tightening up. So they have already been on the watch, and I think are in pretty good shape as far as that is.
Expecting that to continue, potentially. We'll get some more data on that early next month. Margie, thank you for that. As always, Margie Bittal there of Allspring Global Investments. Quick reminder, some good news for you. No Fed speak this week. They're in a quiet period. The Federal Reserve decision is next week on May 3rd. May 4th, you're going to hear from the ECB the same day you get Apple earnings. So that's your tee up for next week. I want to go to a stat, just a number that we got from the team here at Bloomberg. Elena Popina, Jessica Menton putting this one together. Tom, wasn't aware of this. The divide between information technology and the S&P, I think we understand that, but let's put some numbers on it.
Yeah, please.
S&P 500 IT index up 19% in 2023. The S&P 500 up close to 8%. That is Infotech's strongest start to a year relative to the S&P 500 since 2009. That is a big gap that's opened up.
Well, it is. I look at this and I think we're recalibrating. I had the plague last week at the end of the week. It's called doing a Tottenham. And, I had the plague and I really thought about this, John, equity return. And basically we're back out of the bear market. I mean, that's a fact the bears have to adjust to, led by technology coming off the mat. 12 months trailing statistics. John, I didn't know this. You go to the Bloomberg, the WEI function, and you can see this. And I mean, we're literally flat or down 3% where we were down 20%, and it's led by this tech recovery.
Well, but I will say that the interesting thing is the bifurcation, right? That there are a number of big stocks that are driving the rally, and everyone else, as Jurgen Timmer over at Fidelity said, is in nowhere's land. Basically, we're looking at a basically range-bound, market-weighted S&P, even as you have some of these cash-producing behemoths surge.
Thanks to Stuart Kaiser of Citi for this number. About 44% of the S&P 500 market cap reporting this week.
Yeah.
It's a big week coming up for bank earnings.
Big week.
What do you think Spurs are doing this morning, Tom? How do you think the players are?
They're instituting a rebuilding plan, the worst performance by a professional team ever I have
really
witnessed.
That bad?
Ever.
Wow.
It was appalling. I wanted Adele to come in and play fullback.
I have to admit, I was laughing. First 20 minutes I was at home laughing. It was that bad.
Well,
it was brutal.
You're the pro on this, John. I think,
shocking.
John, you ought to fly over there and talk to them about the plan forward.
Yeah, maybe one day. S&P 500 futures, negative 0.2%, live from New York. Welcome back after a weekend. Back to work. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Another blow to France's President Macron and his push to enlist China's help on the war in Ukraine. China's ambassador to France told French TV that the former Soviet states don't have sovereign status as independent nations. Those comments triggered furious reactions, especially in the former Soviet bloc countries, Estonia, Latvia, and Lithuania. China has now backtracked and says it respects the independence of those countries. In Sudan, the international effort to evacuate diplomats and other expatriates picked up over the weekend. The U.S. and U.K. militaries were able to airlift their officials to safety. A temporary ceasefire between Sudan's army and the Rapid Support Forces militia it has battled since April 15th appeared to have failed. House Speaker Kevin McCarthy says the chamber will pass his $1.5 trillion debt ceiling increase this week. Still, Bloomberg's learned that McCarthy hasn't yet lined up all the votes he needs. McCarthy told Fox that President Biden must negotiate in order to avoid a U.S. default. Last week, the president called the Republican plan wacko. Credit Suisse reported $69 billion of outflows in the first quarter. It also took a large write-down at its wealth management unit. All that underscores the challenge for UBS in retaining key clients and assets following the emergency takeover. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
I cannot imagine someone in our conference that would want to go along with Biden's reckless spending. This is responsible. This is something that we have sat down for months, that everybody's had input in. We will hold a vote this week, and we will pass it, and we will send it to the Senate.
The repercussions of this are huge if you go forward as McCarthy wants. What will happen? You will literally see interest rates go up for mortgages, for loans. You're going to see the stock market plummet again.
This debate is truly worse than Fed speak. That was House Speaker Kevin McCarthy on Fox News over the weekend. Democratic Senator Amy Klobuchar on CNN. This conversation is going to continue up until and maybe beyond the X-date. That's a conversation we can have in just a moment. The broader market looks like this morning, and good morning to you. Welcome to the programme. Pushing ahead to earnings from big tech later this week. After the bell, a little bit later, after the close, you're going to hear from First Republic. A lot of struggles for that bank in the first quarter. We'll put some numbers on it a little bit later. In the equity market, futures negative 0.2% on the S&P. Yields come in 3 basis points on a 10-year, 353.94. And if you want to talk politics, just briefly, do you want to talk diplomacy or lack thereof? The Chinese ambassador telling French TV over the weekend that ex-Soviet states don't have sovereign status as independent nations. And then today, this from the foreign ministry spokeswoman of the Chinese Communist Party: China respects the status of the former Soviet republics as sovereign countries after the Soviet Union's dissolution. Maybe things you don't have to wake up and don't want to wake up and say on a Monday morning. You know, that's probably one of them, Tom.
And the speed of the new media. I mean, it used to be by carrier pigeon and fountain pen. And the answer is, with the media, all these nations put foot in mouth. It usually happens on the weekend, I sort of think.
Yep.
You know, and foot in mouth, and then you correct it and move on. I guess that's what they did.
They corrected it, and we'll move on.
Know, but it goes.
Maybe.
Well, that's what I was going to say. I don't think that they can move on that quickly from this kind of thing, just simply because it confirms people's suspicions that they're perhaps more in Russia's pocket than people previously thought.
We should talk with the terrible war. We're talking about a calendar item in April of earnings. How about a calendar item in April of what you do in war, which is wars start now? And of course, literally as we speak, I know Anne-Marie Horton is looking at this on the eastern front of the river, north-south through Ukraine. They're getting ready for a summer offensive.
When we've made some diplomatic errors under this administration, haven't we decided to call it strategic ambiguity? Haven't we done that a few times with this administration and this White House?
I'd ask the deputy.
Was this over the weekend
Prime Minister of the UK
with the Chinese government? Was this strategic ambiguity? Or was that truly a mistake?
I don't know. You just don't know, except it's foot and mouth corrected. That seems to be where we're going. Speaking of foot and mouth, he's very clear in his analysis of Washington. Terry Haynes joins us, founder of Pangea Policy. Terry, I'm very big on expect the unexpected, and to use that word suddenly, there it is. Tax receipts came in a little light, moving this debt crisis discussion from autumn maybe forward, and dare I say, to June as well. Were you surprised that tax receipts for the IRS came in light?
Not particularly, because the IRS itself warns that it's pretty early, and that was done just before the April 17th deadline. So, I'd expect them, frankly, to bounce back up a little bit. That doesn't mean that we're going to get a lot of wiggle room or a lot of breathing room in terms of dealing with the debt ceiling. They're still going to have to do that in the summer, I think.
The Bloomberg Surveillance audience has been looking to autumn, where everybody, it's solved over a weekend. They have a meeting and go, never mind, it didn't happen. And all of a sudden, that's pulled forward. Where is it pulled forward to you? Is it June? Is it July?
I'd say more likely July. I mean, look, I've looked at the past year's receipts, and we've had just in the last fiscal year receipts that were bigger than anticipated. So I think the thumb on the scale here is in for a little more time rather than a little bit less. But still, that's in political terms, that's not very far away at all. And, it is concerning to me that there really haven't been a start to negotiations. I've been saying for 6 months, this is 30-40% likely to result in default. And, I've unfortunately have no reason to change that view.
Terry, I love how John framed this, that basically this is worse than even listening to Fed speak and gaming out what the Fed's going to do, which is a great kind of metric bar to cross. How much do people also hate this discussion of Joe Biden versus Donald Trump yet again? And this seems to be what's coming to the fore. We're expecting to hear perhaps from Joe Biden tomorrow that he is officially running again. And yet, if you look at a recent NBC poll, this is not a popular option. It is not what people want to see in terms of this particular pairing.
I take issue with some of your headline writers who wrote that a Trump-Biden rematch is something that voters are souring on. I wasn't aware they were anything but sour, frankly. I'll be a little non-consensus about this. Think of it this way. Republicans, about four out of 10 want Trump. What that means is about 6 out of 10 don't. And there's a clear alternative in DeSantis that helps DeSantis. On the Democratic side, there's little to no enthusiasm, a real short bench, no real challengers. The mild surprise here is that you had on Friday, you had 6 national polls for president, and polls are what they are, of course. 4 with Biden as the Democrat matcher and 2 with Harris. And Democrats lost 5 out of those 6. Now, they were all tight, but Democrats still lose 5 out of those 6, whether it's Trump or DeSantis. So, this is teetering as we speak, as Biden prepares to announce. And, then I don't think independents really help that much, because independents tend to self-identify with one party or another, even though they don't want to formally call themselves D or R.
So what does this mean in terms of the enthusiasm for this next election? And frankly, going back to the debt ceiling debate, how this plays into something that seems like just a repeat of what we've already seen before?
I only learned 3 things in law school. One of them is to say it depends as much as possible. And in this case, it depends on Trump. And that's you'll find that among a lot of political professionals as well. There's a lot more enthusiasm on the Democratic side if it's Trump you're trying to beat, but if it's somebody else, then there's probably a lot less enthusiasm. And I think the polls in the election probably run based on that assumption.
Terry, just taking a temperature of the media over the weekend, I don't know about you, but I saw several articles declaring the death of a campaign that was never formally announced. Ron DeSantis, the governor of Florida. Terry, I just wonder what you make of that and whether it stacks up with what you're seeing in the polls.
I think Governor DeSantis' demise is premature, to say the least. As I say, I think he's in the position of being the major Trump alternative. That's a position that he wants to be in. I don't think he's interested in being the front runner here, because you get all the slings and arrows at you if you are the front runner. I think he's been surprised to some extent by the focus and energy of the developing Trump campaign, as well as the supposed apostasy of a lot of Florida members who you think might support him, who are instead going to Trump. To me, that's all fixable. That has a lot more to do with a signal being sent to DeSantis by Florida legislators that he'd better pay attention to them than anything else.
Hey, Terry, wonderful to get your perspective on these things. As always, Terry Haynes there of Pangea Policy. Tom, let's start with the debt ceiling, maybe finish there. The debt ceiling ex-date after the tax receipts of last week. Mike McKee did a great job of breaking this down for us on this programme. It feels like it's got a little bit closer, doesn't it?
Yeah, it's absolutely got closer here. I am completely biased on this from my childhood, where like a Swiss watch, every number of years, this was a crisis, and the crisis always goes away. 2011 was sporting, to say the least. But the answer is I'm hugely biased, like Wall Street, to say, okay, fine, Terry, talk about it, but it'll go away. And yet, I'm watching markets say to me, including CDSU, yes, maybe this time is
different.
There
is always that worry.
This is Lisa's world. Why are you talking to me? Talk to Bramwell.
There is always that worry.
Well, things have gotten that much more polarized. This really just sort of exemplifies, once again, how partisan Wall Street has gotten and Washington has gotten.
Jens Nordvig of Verdante Data is coming up very shortly. Looking forward to that conversation with your FX market. Seeing a euro back through 110, 110.11 on euro dollar. Live from New York, welcome to the programme. Here's your equity market on the S&P 500. Slightly softer, negative. Starting the week this Monday, down about 0.2%. On the Nasdaq, negative 0.2% after some marginal losses on the benchmark, the S&P, just last week, down by 0.1%. In the bond market, 2-year, 10-year, 30-year, we look like this. Yields lower by 2 basis points on a 2-year, 4.1585 the whole of last week, Monday through Friday. Your 2-year yield north of 4%. The Fed goes quiet. This bond market has been anything but. Of course, it's not just the Federal Reserve that has to decide next week. It's also the ECB. Let's finish on euro dollar. Quick, brief look at things right now on the euro. We are at 110.10, a breakthrough 110 again. 110.10, we're positive by 0.2%. The euro showing just a little bit of strength as we count you down to the Fed decision next Wednesday, followed by the ECB on Thursday. Jens Nordvig of Exante Data weighing in and writing this. At this point, we do not have high conviction in the May catalyst of a Fed pause, but we think there will be ECB and Fed divergence over the coming 3 to 4 months as the ECB has more work to do and less banking tension uncertainty. TK, I don't think he's the only one that shares that view.
But he really carries authority here. His book on the euro was definitive coming out of the great financial crisis. Jens Nordvig joins us right now, an important moment with Exante Data. Jens, perfect timing here. We see the arch other pair, euro-yen, breakout. Strong euro weak yen, technically through 148, is a huge deal against strong euro. Explain to mere mortals what the significance of a euro-yen breakout means.
Yeah, so we've had a situation here over the last month or so, right, where we had significant banking tension. It was not just in the U.S. We also saw pressure on Credit Suisse, Deutsche Bank, and so forth. And we've had a significant relief from that. So we've had euro-yen essentially go up 4 or 5% from those lows. So it's a very significant bounce as those banking tension concerns in the Eurozone have really been pushed in the background. In the US, it's a little bit more complicated. But so we have a very significant movement. At the same time, we continue to have this elevated speculation about whether the Bank of Japan is going to do something, right? We've had incredible volatility around Bank of Japan meetings. We have another one this week. And now the new Bank of Japan leadership is essentially signaling that they will still be patient. So I wouldn't say it's still the same as Corona, right? But they're signaling that they are not in a rush to exit from the easing. So those are the things that's really pushing euro-yen pretty significantly higher.
Jens, your book on the euro 10, 15 years ago was definitive on what the euro needs to be. Has Europe escaped eurosclerosis? Has Europe, you know, with the experiment coming out of the advent of the euro, have they escaped that permanent unemployment? Have they found a more Anglo-Saxon prosperity?
We continue to see that when there's a crisis in Europe, the leadership tends to come together and do more stuff that they've been willing to do in the past, right? So the coronavirus episode was another example of them doing more. Next generation EU funds are still being dispersed around the European Union to support countries that need it. So we have essentially a degree of fiscal union building, right? So that was something that was missing, and we're having a degree of it. That's certainly helping on that front. There's a lot of talk about having a banking union as well, right? When you have banking tension, there's focus on supporting the banking system in various ways. And we're having that discussion again, right? So we're not there yet. But I think the one thing that's really important that is different from when I wrote that book is we had those political tension that caused uncertainty about, okay, do the different countries have the willingness to do what it takes to stay in the Eurozone? We don't really have those debates at the moment. There's no debate in Italy about leaving the euro right now. There's no debate in Spain or other countries, right? So if you do opinion polls, do people want to stick with the euro? There's actually rising support for the euro. So that's something that cements the euro status, despite all the difficulties there is with economic integration and so forth.
This was the reason why, Jens, a lot of people earlier this year said that European equities in particular were a real place of brightness for the full year, given not only all of this potential optimism, but also this idea that they're not as tech heavy at a time when there would be a rotation out of that. Well, it hasn't really worked out that way. And you've seen actually big tech continue to lead in the U.S. When is that going to shift? Is Europe ever going to basically create some other complex like it to rival the tech giants in the U.S.?
Well, so the European stock trade, like for example in banking space, has worked out, right? So BNP has recovered 20% from the lows, is up significantly in the year. So the fact that interest rates are rising is creating a different environment for equities and banks, and done very well. Obviously, Europe doesn't have a tech sector, so on that front, tech sector to speak of. So on that front, the U.S. is going to be leading. But I think overall, we have a situation where European equity markets had outperformed U.S. equity markets for the first time in a long time, right? You can argue whether it's Europe outperforming or the U.S. underperforming outside of tech, and that's something that's very interesting. Don't forget that we've had a situation where last year we had like a very, very serious energy crisis in the Eurozone, right? And now energy prices have dropped very notably, right? So part of the reason why we have the euro strong, European stocks also can do relatively well this year is that energy crisis has abated. Consumer confidence has come back. You look at the services PMI. Services PMIs have just risen over the last couple of months, right? So we've really recovered from that energy shock in a way that has supported the European economy. And obviously the ECB is still facing inflation, right? So the combination of too high inflation and growth that's actually getting better means that it's very, very hard for the ECB to relax. They have to continue going, as we heard today as well.
So Jens, basically it sounds like you are still very bullish on European banks and European equities more broadly, as well as the euro.
So I was tweeting very aggressively about it a month ago, and I actually did a summary tweet yesterday about it on my handle. Like there was no particular reason to think Deutsche Bank was just about to go under, right? And we've recovered from that dramatic shock, and I think there's still some reason to think that we're out of zero interest rate world that's supportive for the banking system overall. And for the euro, the ECB is going to continue to support it. So I think the big question here is what is global growth going to do? That's super important for the dollar. And we have some question marks in Asia now. So that's the new things that we're starting to really focus on in our research right now.
Okay, let's go there. On China, how does China fit into speculating or betting on a given currency pair? Which pair gives you the greatest efficacy to play your China guess?
So typically when we've had, China stimulus, China growth recovery, it's been currencies like Aussie dollar that has benefited from it, Korean won. And we had a period in January and February where China-linked assets all around the world, from casino stocks to tourism stocks and so forth, all rallied hard. And now we've come to a point where it feels that some of those trades are very fully priced. And actually, it's sort of the longer-term growth concerns that are starting to feed into price action. We can see that in Chinese equities rolling over. We can see it in iron ore rolling over. So it's kind of one of those things where perhaps we got it very fully embedded and we start to look at the more medium-term picture as opposed to just that short-term shock.
So are you saying AUD-KRW is the most efficient pair to play a China guess?
So I think when you have a growth bounce in Europe, those are the assets that are moving. And I think right now, if we look at, we have like very high frequency tracking of Chinese growth where we look at, okay, what is the momentum? And we can see at the end of March, that's when we kind of had a peak in Chinese growth. And since then, over the last 3-4 weeks, we've started to see the real momentum in the Chinese economy potentially peak out. And therefore, you have to be a little bit more careful with those sort of China growth sensitive assets right now.
Jens, wonderful to get your perspective on that. Jens Nordvik there, Fixante Data. Let's build on that perspective. At the end of September, you got a bottom in the currency pair euro-dollar. A couple of days after that, also at the end of September, that kind of time frame, the Euro Stoxx 50 bottom. Euro Stoxx 50 since then is up more than 30%. European equity outperformance has been absolutely phenomenal. And what do we get this morning from the team at JP Morgan and the investment bank? Mislav Matejka writing this: "We are remaining overweight Europe versus the US for now, but think that the time to take profits on the trade is approaching." We've talked about the outperformance in tech to start this program ahead of tech earnings, and I think we're all thinking the same thing. Can that continue? Will the earnings validate it? Another part of this conversation as well is the outperformance regionally. So within the US, tech outperforms on a sector basis. When you look at things geographically, Europe outperforms. Now, does something have to give here? And is Mislav Matejka onto something over at JP Morgan, Tom? Is the time to take profits on the trade fast approaching?
It's easy to make alpha off the bottom if you guess it right. And that's the key phrase. You got to get it right, and up goes tech. And you mentioned, I think, Facebook Meta is up like a gazillion. NVIDIA
Meta's flying.
is another example of that. To Jens, and folks, that was a world-class discussion there with Jens Nordvig of these dynamics. You got to have a belief or a bet. And I'm just looking at the biggest thing in the room, which is China. And the arch bet is, can they deliver, what, Lisa, 4.5%, 5% growth, or do they deliver 6% growth and the gloom crew gets it wrong? I don't have an axe to grind in this.
Well, let's say that they do have 6% GDP growth. Let's say they achieve that, which some houses on Wall Street have actually upgraded it to. Will that actually give the boost to the global economy that many people are expecting?
What's Jay Pulaski say? He won't talk to me.
Well, you know what he says. He's very constructive on the global economy, very constructive on international outperformance.
There you go, Lisa.
But to Lisa's point, and I think Lisa's onto something, this is about what time frame you look at. It's not about 5 or 6. It's about whether we have those kind of numbers next year, and no one thinks so. So when you look at the market and what we're pricing, it's what are we responding to, what are we focused on? And what Jens is talking about, what Jens is talking about, Lisa, is basically the days of focusing on 5, 6, a pop-off reopening might be fading now. Now might be the time where we start to price in next year and start to think about the economy there, GDP, starting to fade just a little bit more.
The year-over-year comparison is fairly easy when it comes to GDP. It's what happens on a longer trajectory at a time where there still is a lot of angst, and not only that, but also really high unemployment in the younger populations, which is causing a lot of stress internally. So a lot of questions, which is also the reason why I think one of the most notable moves is just how much oil prices have declined over the past couple of weeks, despite the reopening that people talk about.
Just to go through the earnings calendar, just briefly, tomorrow, Google, Microsoft, Wednesday, Meta, onto Thursday, we get Amazon, then early next week, in fact, I believe Thursday, we get Apple next week.
We haven't even mentioned it. The Bezos restructuring or the pandemic restructuring at Amazon is maybe the great story we're not talking about.
Well, the post-Bezos
restructuring. They have to report on this. I have no idea what we're going to hear from Amazon. I have no clue, other than they're going to raise the Prime thing. They're going to raise the Prime thing.
Again.
$10.
How much is that now?
It's a lot. It's ginormous. It's like 100-something a year, right?
I think something like that, yeah. They take that from me annually, I believe.
Do you know what the currency of Azerbaijan is? The Manat. M-A-N-A-T.
The Manat. Why are we talking about that?
Because F1 race. We got to come back and talk about it.
You want to get over there for that?
I think it's cheaper than Paris.
Which race is that? Baku.
Baku.
Very cool. Street race, I believe.
Like Monte Carlo.
Very tight corners.
Oh, very cool.
Just have a look at it. Equity futures right now down 0.2% on the S&P 500. Yields are lower by 3 basis points. Your yield on a 10-year, 353.94.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Possible presidential candidate Ron DeSantis met with Japan's Prime Minister Fumio Kishida in Tokyo. It was a chance for Florida's Republican governor to burnish his foreign policy credentials. DeSantis said he appreciated Japan's efforts to boost its defenses. Japan has increased military spending, in part due to China's threats toward Taiwan. The U.S. has asked South Korea not to boost chip sales in China if Beijing bans U.S.-based Micron from selling there. That's according to the Financial Times. Beijing has launched a national security review into Micron, one of 3 dominant players in the global DRAM memory chip market. Now, South Korea's Samsung and SK Hynix are the other 2. In the UK, Prime Minister Rishi Sunak's government will try to fill the void created by the implosion of the country's main business lobby. Sunak meets today with about 200 of the UK's major business leaders and investors. That comes after dozens of companies quit the Confederation of British Industry. There have been allegations of rape and sexual misconduct against CBI staffers. And it's the end of the line for Bed Bath & Beyond. The home goods chain will close all of its stores and liquidate inventory over the next 2 months. A turnaround attempt failed, leading the company to file for bankruptcy protection. Bed Bath & Beyond employs about 14,000 people in the U.S. and Puerto Rico. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Growth continues to slow, and that continues to pressure profits and put us further into this earnings recession that we've already been in. Nothing's collapsing. There's a lot of fears of, the carryover from the banking crisis and things were going to fall apart. That's not the case, but things continue to get worse.
Fantastic to hear from Dan Suzuki there, the Deputy CIO at Richard Bernstein Advisors. Welcome to the programme this morning. Lots of tech earnings in our future this week. A little bit later on this afternoon, you're going to hear from First Republic. That was a bank that got into a lot of trouble in the first quarter. We'll put some numbers on that trouble in just a moment. And Tom, we can put some numbers on the trouble over at Credit Suisse in the first quarter.
Really, let's get to that in a moment. I want to go back to Dan Suzuki. I think it's so important, John, because that's a sentiment out there right now. And Ben Laidler nailed it in his morning note. He says, look, we're all talking about this equity mumbo-jumbo amid the poor sentiment, like we heard from Richard Bernstein and like we heard from Dan Suzuki.
So RB are pretty clear on this, where they think the outperformance should come from, and it's not where the outperformance has been, which is tech. They've been pushing back against that all year. They think it's time for new leadership and a very different equity market to be invested in.
Some of the emotion we'll give you here, folks, through the week, exciting week. I'm going to take it all the way over to May 4 and the Apple earnings as well. We have to have team coverage here of what we do in Switzerland. It's always the case. And what we know is when the Amex comes out, Manus Cranny always ponies up for the Zurich $25 bowl of parsnip and coriander soup. That's how expensive Zurich is as they lay off a gazillion thousand people. Manus, let's start with Credit Suisse behind you and UBS off your right shoulder. How many bodies will go out the door?
Probably an awful lot more than you, myself, Tom, and John anticipate. The original plan for the dissection of this institution was around 9,000 jobs. By the time the new incumbent, or the returning incumbent, I should say, Sergio Motti, returns to UBS, many years ago, he sat down in an interview and he said, I've got to lay off nearly 10,000 people. It never quite got there. But the risk is this. The duplications are profound. The numbers will be much more than 9,000. And if you and your audience want to understand the smell of fear, it's in the price tag of 61 billion Swiss francs walked out the door of Credit Suisse. Those are the fee-generating assets. That is nowhere near as brutal as the implosion in the fourth quarter, which was a stench of liquidity or lack thereof. So the 60 billion is nowhere near what the market anticipated. Look at UBS's stock price. It's up 2%. Question one to Armati tomorrow. What did you get from the institution here that has seen over 170 billion go out the door in the space of 6 months? That's the risk to the trade. How do you stop the rot and stench, draw a line under the stench of the exodus?
Manus, I have to say, just to jump in, and great to catch up with you, buddy, as always, that number that you put on the fear of Q1 was much smaller than I thought a lot of people think it would be, $69 billion. And I just wonder, Manus, what you're hearing people saying about this. Did the regulator get too scared? Because when we all watched that news conference, it didn't sound like $69 billion of outflows. It sounded like a heck of a lot more than that.
It did. However, I think you got to look at some other numbers. Jonathan, sorry to be boring about it rather than my sort of usual verbosity. God forbid that I would be verbose. Credit Suisse had to draw down over 100 billion in liquidity, and they have warned very, very clearly there would be further substantial losses, and that the liquidity lifeline that was given to them by the government is something that they may well have to tap again. Be very clear. There are two very different types of money that go out the door. One are deposits. Flick of a switch on Swift, it's gone. It's gone within minutes. It's gone within hours. The more important set of assets that we need to consider are those sticky assets, which are part of relationship, which are inherent in the institution that has been around for 160 years. This is one of those Damascene moments where every wealth manager in the world, every young guy and girl who's trying to build a book, they're knocking on the door. This is the moment when the risk to this institution is that not just a dissipation of assets under management, but that it rolls up into something much bigger. And that's the risk to the big trade, Jonathan. You're bang on the money. 60 is less than the 100 that was on the street. That's what we anticipated. But deposits, the rich don't hang around when they smell fear. 57% of this outflow is deposits from wealth. 9% of wealth walked out the door.
Well, a lot of other people walked out the door too, Manus, including a lot of the talent on the money management side as people try to gauge whether or not UBS is going to offer Credit Suisse individuals jobs. So this really is my question. What did we learn over this particular earnings season about how difficult the integration process is going to be for UBS and how they will want to potentially expedite it?
So you have one individual here. There are many individuals, but I will focus on Iqbal Khan. The pressure on him is going to be immense. This is your moment. You are the sole leader of wealth management as it stands at the moment in UBS. We understand he's already been on the road in Asia. And make no bones about it, Asia is going to be the battleground for those super wealthy across China, Hong Kong and Asia. To keep them is to keep the Ballon d'Or. To keep European money is something which is probably a lot harder to prize. And believe me, I've tried to prize the odd billionaire in my career to move with me from one institution to another. The road to hell is paved with good intentions. They promise you a lot, and a lot of them did not deliver. They owe me.
Manus, what are the good intentions of the Zurich and the Swiss people? There's a canton independence. There's a less federal structure, maybe alluding for Americans to Canada. How does Swiss domestic politics play into what's going to go on back and forth of those two buildings behind you?
Politics is, it's a dirty business, isn't it, Tom? It's a dirty business in every country in the world. So politicians must be seen, they must be heard, and they must defend the people. But the reality of it is, as much as the politicians may jangle the keys of angst in the government here, the reality of it is this institution would have gone under. Okay? These were the cantons that pulled liquidity. The small banks around here and that permeate around this nucleus of Zurich where I'm standing, they pulled the lifeline. They pulled those counterparty, let's say, lines. That's what really invoked the downfall of Credit Suisse. Counterparty reaction. You saw it in 2008, and the politicians have got to sound as if they are standing up and doing the right thing, to be seen to do the right thing. That is their job. But when the hurly-burly's done and the battle's lost and won, there's only one victor. Well, actually three. Ermotti, Kelleher and Khan.
Hey, Manus, just absolutely phenomenal reporting from Zurich. Thank you, sir. Manus Cranny in Zurich, Switzerland, covering Credit Suisse today. Tom, UBS tomorrow.
UBS tomorrow. Lisa mentioned this as we got ready for the show. Maybe that's way more important than the sadness of a bankrupt or taken out at Credit Suisse as well. What's important there is Manus's street cred, his Wall Street skill on a global basis. And he's seen this before. I mean, DLJ and Credit Suisse years ago was as clumsy as they come. And this is obviously in a far more emergent condition, but this stuff is a mess.
A big mess. And to some extent, the numbers today, Lisa, inform the conversation we'll have tomorrow. It's about what kind of institution you've bought. We understand the numbers from UBS's side of things, what they paid for it, but the state the bank was in when they took it over. We've got a better picture of that today.
Yeah, and perhaps it wasn't the worst case scenario, but still you see flight, and you also see some hesitance to keep working at a place where supposedly you're going to have an integration process that's going to cause a lot of layoffs and it's going to take potentially 4 years. You have to wonder what people are thinking when their managers over at Credit Suisse tell them to treat UBS still like a competitor. I mean, at what point is the message kind of getting a little muddy?
What I would emphasize, John, is these are well-meaning executives making it up as they go. And the good news is they have Keller, who's been through this many times. Here's a paragraph. Here's a paragraph, okay? Dillon Reed. In 1991, it was acquired by Barings Bank. That was a train wreck. And in 1997, 6 years later, it was acquired by Swiss Bank Corp, which was in turn acquired by UBS in 1998. That's the kind of deal-making that's the heritage of Zurich, to see 1, 2, 3, 4, and now this final blow up here that's riled up the Swiss people.
So the number I'd love at this point is how much of that money that went out the door of Credit Suisse in Q1 went in the door at UBS in Q1. I'd love to know that figure, because a lot of people at the same time, Tom, I think ultra high net worth individuals will have relationships at both banks to begin with. And I just wonder, Lisa, how that's developed in Q1.
Yeah, and whether this is sort of the logical place to go or whether they look for others to potentially diversify. Just want to give you this. We are getting a bunch of earnings throughout the morning. We just got Coca-Cola, and it came in with a pretty massive beat with organic revenue for the first quarter coming in up 12% versus the estimate of 9.6%. The comparable EPS was 68 cents versus 65 cents. If you are one with pricing power, you can price upward and you can shrink it. Shrinkflation bothers me so much, I've got to say. That's it.
Do you want some time to complain about that?
Yeah, I don't know if
20
we have
seconds.
time.
You've got 20. Just give us an example.
It's like you think you're getting a certain thing, and then you're done right away. And it's just like, really?
It's called college tuition.
Equity futures right now, negative 0.2%. This is Bloomberg.
It's a really tricky time for the market because things are slowing.
Growth continues to slow, and that continues to pressure profits.
There's just a lot of great news priced into great companies right now.
If the consensus is talking about some sort of cliff dive moment in the second quarter, that's not happening.
This is ultimately really going to be, I think, a defining earnings season for winners and losers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Getting your week started live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market negative 0.1% on the S&P 500. Your week is going to look a little something like this. After the close a little bit later, we get First Republic. Terrible quarter. We'll put some numbers on that difficult quarter for that lender. Then later in the week, Google and Microsoft tomorrow. On Wednesday, Meta, Facebook, call it whatever you like. On Thursday, Amazon. Tom, on to next week, Apple.
On to next week, I'm going to steal from the Beatles. What a great album it was, 8 days a week. Maybe it's 9 days a week here to get out to Apple. But the whole continuum of this is great. And as we mentioned with Amazon in the last hour, even more so than the banks, each story is different. Like I'm off the Google story, and I'm absolutely fascinated how Google, maybe they've stumbled a little bit in the last year strategically. How do they frame the story forward? Just as one of the vignettes of it.
Cloud spend's going to be a big deal as well. Consumer price tolerance has been a theme for us as well over the last 2 years, I'd say, coming out of the pandemic with inflation as high as it has been. Lisa, getting another flavour of that this morning.
Well, I'm looking at Coca-Cola. That's probably what you can see, and that they beat expectations. Their earnings per share for the first quarter was 68 cents versus 65 cents. You can see that they beat on terms of how much their revenues increased, 12% versus less than 10%. How much is this? Because they are able to juice prices. They are able to shrink those cans that you used to get 8 ounces in that now you get perhaps 4 ounces in, and you pay the same. Woo! I mean, honestly, you get all of these kinds of tweaks, and all of a sudden you have earnings that are better than good. And you're seeing that at a number of big brands that are recognizable.
I'll let you pick up on that. She's fired up. Up 7% pre-pandemic, up 69%, make it 70% off the bottom of the pandemic. We're all going to die. No one's going to drink Coke. Boom.
Lisa, tell us what you really think.
Well, look, I just think that on one hand, when do you get the pushback for getting less and paying more? And you see that with the airlines, and you see that with certain consumer brands. And the reality is we're just not seeing it in a dramatic way yet, certainly in those certain categories, which is the reason why when everyone comes on and they say they're looking for companies with pricing power, that's what they're saying. Who is going to continue to be able to give less and demand more? And that's really what we're seeing.
You know, why do we do this economic babble, folks? It goes down to that banner on the radio right now.
Babble?
No, not you. No, on the banner on television right now. For those of you on radio, Coca-Cola first quarter adjusted organic revenue growth up 12%. I've never seen that number ever. And it's price in units, Elisa. And you're right. They've got, it seems they have maximum pricing power. When's it end?
You want to talk about real pricing power? LVMH. Can we get back to that headline from earlier on this morning? We have a $500 billion company in Europe, Tom. For the first time, $500 billion. It's the luxury player, LVMH, at more than 30% year to date.
I believe I saw in the blur, LVMH and Hermes together make up 21% of the CAC 40 market cap. Two stocks in luxury. I mean, this is not Apple where everybody's got an Apple phone and that. They make up 20, I believe it's 21% of CAC 40. I even said CAC 40. Ken Pruitt and I. True story. Surveillance story. The late, great Ken Pruitt. he and I used to argue. He'd be quoting the CAC 40. I go, Ken, nobody cares.
Yeah, it's
and he's like, Tom, they care about the CAC 40. So there it is.
LVMH is 13% of the CAC 40. 13.
You know, is this the new gold? Is this the new kind of hard asset that people put their money into? I just wonder how much this is really just being driven by revenge spending by people in China who suddenly can travel, who can suddenly go out. And I wonder if this is the main story behind some of this luxury spend, and the fact that people who saved who are in the upper income gained a lot more during the pandemic and now have it to spend.
I thought it was interesting what Patrick Armstrong said on several levels from Plurimi Wealth around this name. He had this name, he basically rode the wave, then he sold it. And Tom, what's interesting about the why he sold it, more broadly, there's a theme here about upping quality and everyone's buying the same thing right now. That's one point. The second point was, once a company rallies this much, gets as large as it has done, he thinks there's going to be pressure on LVMH to make another big acquisition.
That's why they did the bond deal last week. I hear about this all the time, John. I go back, and I'm an amateur at this. Good morning to any number of people in New York that have helped me so much on luxury finance. It changed with Laura Piana. There was a day where not all, but part of Laura Piana was taken out, and no one in the industry's ever recovered by that $1 billion transaction. What would they pay for you name it? I don't.
Well, we did try and name them on Friday. We missed you, Tom, because we went through a long list of luxury names that LVMH turned out already owned.
We couldn't find one for them to acquire.
Can you think of one that they don't own already?
Brunello, they don't. I checked after.
Okay.
Yeah.
Good to know.
I've never been in Brunello. I go by. It's too intimidating. It looks too expensive.
Brunello's very cool. Stealth wealth. Stealth wealth.
It's like
not my phrase.
Stealth wealth. That's very in right now.
It's a great phrase.
That's the way you dress on the weekends, isn't it?
Stealth
like no labels, no nothing.
Logos, no branding.
It's like
just,
a Succession thing.
If you know, you know.
Do you have the black paste, the Laura Piana? You have the Laura Piana baseball cap.
Let's move on. Your equity market looks like this. One of those Kendall Roy, Laura Piana black caps.
I got the San Diego Padres and the Red Sox, and Ferro's got Laura Piana going.
TK, this is so out of touch. Let's get to the equity market. We're negative 0.1%. In the bond market, we're shaping up as follows on treasuries. Yields come in 3 basis points. Lisa, 354 on a 10-year.
All right, just whipping through what we're looking at today. A quiet day ahead of some really big earnings. We get on the data front, Chicago Fed National Activity Index for March. That comes out at 8:30. U.S. Dallas Fed manufacturing activity for April. Do we see the same kind of resurgence that we saw in last week's PMIs? Then we get the change in a VIX index that people have been looking at. The SIBO Global Markets organization is creating a new one that might reflect the day-to-day volatility better. It's a one-day kind of volatility index. So far, we're not seeing any kind of indication from the benchmark VIX index that we're going to see an increase in volatility, which is a lot of people curious. In aftermarket, we get First Republic Bank earnings, which will perhaps give some indication of the stress over there.
Looking forward to those numbers a little bit later. Joining us now is Linda Dussel, Senior Vice President and Senior Equity Strategist at Federated Hermes. All looking ahead, Linda, to the tech earnings later on this week. I'd just like to start with what you're looking for and whether you expect those names to validate what we've seen so far in stock performance this year.
Yeah, well, thanks. Good morning. Thanks for having me today. And of course, you just mentioned the VIX being low. And one of the reasons the VIX has been low and has surprised everybody as versus the bond market index is because it's heavily weighted by these big names, many of which are big tech names. And the tech companies probably will do okay. Pretty much what we've seen so far this earnings season to date is better than feared. That's kind of what we're up against here now is better than feared. And it's going to be very hard, I would think, for tech companies to give us earnings that would surprise enough to really move the stocks a lot, since it's a very crowded trade right now.
Linda, with immense respect for Federated's ability to be in the equity market, is this a bull market?
This is it's. I heard you say earlier today that we're in a bull market again. We believe we're still in a bear market, a mixed market. We think we've seen the worst of it. What we're in is a very slow-moving market, now 7 months in a range. And we continue to believe at Federated Hermes that we're going to be caught in a wide range that we're at the high end of right now, and probably for maybe another 9 to 12 months. We're looking at a 1% GDP this year and next. I've been thinking of a fun word to describe this is slowflation, slow growth and inflation that's still going to be more stubborn than you would have liked. Tough to be a bull and tough to be a bear.
Linda, you talk about tech and how that's really led a lot of the indexes this year. If you take a look at the S&P market-weighted cap, you can see that it has outperformed the equal-weighted cap, I believe, for the quarter, going back for the first time since March of 2020. So I'm wondering from your perspective whether that has to reverse, whether that has to kind of right-size itself, or whether it has legs, because those behemoths are generating so much cash and, frankly, are still demonstrating a lot of sales.
Yeah, that's the problem. That it's tough to really make a big bet like that against behemoths that are so very doing so very, very well. It's great to see that at least they're joined by a staples company, Coca-Cola. The big behemoths will carry us through in kind of a slow growth type of an environment. It's just hard to really see a big increase in terms of the stock price when you're such a behemoth. What it does is it protects our economy from really what could be a bad recession, because they're in such great shape. And as you've already mentioned, there's still so very much money on the sidelines, and to include consumers' pockets, so they can pay up for those little cans of Coke.
Linda, have you noticed that everyone's saying the same thing? Let's play defense. And then they've got different definitions of what defense actually means. Some people say it's utilities, healthcare. Other people might say it's tech, mega cap tech. Other people might say it's luxury. LVMH over in Europe may be an example of that. Linda, what is defense to you?
Oh, that's interesting. Yeah. What is a bank? A bank used to be a bank, and now a bank is a big tech stock, right? So to us, defense is it's kind of a turtle wins the race. It's a company, it's a stock, I should say, a company who is mature, who has a lot of market cap, a lot of cash to weather their way through difficult environments, and strong enough to give you a nice income stream. So, the way we...
I think we lost that connection there with Linda Dussel there at the very end of those comments of Federated Hermes. I think we understand where she was going with them, though, Tom.
Yeah.
What defense is to Linda and what defense is to ultimately other people.
How do you participate? And this is inflammatory. How do you participate scared stiff? Okay, that was like X months ago. COVID,
sure.
The bottom. How do you participate now after recovery? And particularly, how do you participate now if you didn't participate in the bounce out of the pandemic? Those people have this immense immediate regret of what they missed in the recovery. And that's where you have to build an interior confidence to get in the market. Now, my answer is a triple leveraged all cash fund is a place for comfort.
That's
right
the
now.
pitch. That's the pitch. There are all these interesting different points of tension, Lisa, that you and I have been touching on over the last week. The S&P 500 north of 4,000. The VIX, you mentioned the VIX, very low. CPI at 5%, let's call it. Unemployment at 3.5%, and a market pricing in cuts. Does something have to give? Can you reconcile all those things right now?
I personally cannot. There are people who say that a soft landing is still possible, and that could involve some sort of Fed rate cut. But if you believe this economy is stronger than it has been heading into other recessions, hard to see why the Fed would cut rates so aggressively this year.
On that topic, Drew Madison, MetLife, coming up in the next hour, about 50 minutes from now. Looking forward to that conversation. As we begin a brand new trading week, your equity market negative about 0.1%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy says the chamber will pass his $1.5 trillion debt ceiling increase this week. Still, Bloomberg's learned that McCarthy hasn't yet lined up all the votes he needs. McCarthy told Fox that President Biden must negotiate in order to avoid a U.S. default. Last week, the president called the Republican plan wacko. Another blow to France's President Macron and his push to enlist China's help on the war in Ukraine. China's ambassador to France told French TV that the former Soviet states don't have sovereign status as independent nations. Those comments triggered furious reactions, especially in the former Soviet bloc countries Estonia, Latvia, and Lithuania. China has now backtracked and says it respects the independence of those countries. In Sudan, the international effort to evacuate diplomats and other expatriates picked up over the weekend. The U.S. and UK militaries were set to airlift their officials to safety. Now, a temporary ceasefire between Sudan's army and the Rapid Support Forces militia that it has battled since April 15th appeared to have failed. The CEO of NBC Universal is leaving after admitting to an inappropriate relationship with an employee. In a statement after an investigation, Jeff Shell said that he deeply regrets the incident. He served as CEO since January 2020 and worked at NBC Universal parent Comcast for almost 2 decades. A replacement has not been announced. And it's the end of the line for Bed Bath & Beyond. The home goods chain will close all of its stores and liquidate inventory over the next 2 months. A turnaround attempt failed, leading the company to file for bankruptcy protection. Bed Bath & Beyond employs about 14,000 people in the U.S. and Puerto Rico. I'm Lisa Mateo. This is Bloomberg.
I cannot imagine someone in our conference that would want to go along with Biden's reckless spending. This is responsible. This is something that we have sat down for months, that everybody's had input in. We will hold a vote this week, and we will pass it, and we will send it to the Senate.
The repercussions of this are huge if you go forward as McCarthy wants. What will happen? You will literally see interest rates go up for mortgages, for loans. You're going to see the stock market plummet again.
That's the back and forth right now. House Speaker Kevin McCarthy on Fox News and Democratic strategist on the market, Senator Amy Klobuchar on CNN.
Oh,
Senator Klobuchar, global strategist down in Washington, D.C. on financial markets.
Did our team do that?
The team did that one.
It does great.
Yeah.
It really captures
market strategy from politicians, Tom. Never encouraging. I'm always uncomfortable. Both sides, I think what Speaker McCarthy did the other week was the same thing. Really sort of taunting markets with what might happen further down the road, trying to sort of get a reaction. And I remember when President Obama did the same thing, by the way. I remember the same thing. Trying to encourage a reaction to force people over the finish line to agree to something.
Totally.
It's a game I don't think you really want to play.
They want to freak out so that they can say, look, this is a problem. We need to get on it. The American people are concerned. And if you don't have that empirical data of money is getting lost, then it becomes harder to get people
2011 snuck up on me. I really did not see that coming. I believe it was 2011 where there was serious Washington angst. And it's not that I missed it, but it was just, it snuck up on me quickly. And I wonder if that's where we are on this Monday morning.
Well, just to recap, Tom, you mentioned it in the last hour. Mike McKee talked about it last week. We got some numbers on tax receipts for Treasury. They've fallen a bit below expectations in most places. Brings the ex-date forward, Tom, just a little bit.
Yeah, it does. What we're going to do is catch up with this right now and also catch up with the relationship transatlantic. John has really led on this coverage over the last number of weeks. Julie Norman joins us at the University College London UCL Center on U.S. politics. I'm really taken, Julie, by the distance across the Atlantic. Mr. Macron's been jetting around, avoiding domestic issues in France. And I saw in an Asian paper the idea of America as observer. What's the level of our isolationism right now? Is the United States of America going to be a global observer?
Well, I definitely don't think we're at that point yet, Tom, and I don't think China's read on us is quite right in that regard. Obviously, we've seen so far that the U.S. is playing a really key leadership role in Europe with everything going on in Ukraine, and moreover, in the coming years, is just going to need to be a leader in how the world and the U.S. engages with China. And of course, not all of Europe is going to go along with everything that the U.S. posits on that front. But the U.S. is not going to be stepping back on that, I think, regardless of who is in the White House after 2024.
What is the diplomatic stance right now that the U.S. needs to do? Are we patient and removed, or do we need to be assertive to rebuild relationships with Europe?
Yeah, I mean, it's a good question, Tom, because I think both parties have a will to have the U.S. be seen as a leader internationally. You don't want to be on the back foot. You don't want to be leading from behind, as is often the critique. But at the same time, there's often an unwillingness to put the resources behind that. And so that's often what we're seeing now from especially the more populist or MAGA wing of the Republican Party. The sense is it worth giving the amount of resources that the U.S. is currently doing to foreign policy that some would rather see used at home? But it's hard to not spend those resources and still have that same kind of leadership. So finding that balance is always a little politically tricky. I think Biden has obviously been very much leaning into that multilateral role. But again, if we have a change in the White House in 2 years, that's going to probably look a little bit different.
Julie, John was mentioning earlier this morning about this perhaps faux pas over the weekend in a French media interview with the Chinese ambassador, talking about this potential for not recognizing former Soviet states and their statehood as much as the rest of the world does, and then trying to walk it back. What do you make of this?
Yeah, so that it did seem apparently like a faux pas, but again, one that you had to assume had some kind of strategy behind it. And I think right now we see China really trying to play different actors to to their own benefit. I mean, that includes Russia, that includes the US, and that includes Europe. So I don't think some in China will be shy about saying things that they know will be provocative, that they know are going to push some in Europe the wrong way, if it can help them in some of their other aims right now with Russia, and then kind of walk it back when they need to as well. So I think there's a little bit of testing the waters going on there, but it certainly was a kind of a curious statement, especially at this point to say that. So I doubt that's one they'll be coming back to, but it could have just been a testing the water sort of move.
But Julie, you said something that's pretty compelling there, that they might be looking to curry favor with Russia. Can you get a sense of what the relationship is, how close this reliance is, not just Russia on China, but China on Russia for certain, whether it's strategic or if it's, just lines of trade kind of perspective?
Sure. Well, you said it there, Lisa. I mean, Russia obviously needs China much more than China needs Russia right now. So right now, China is kind of taking advantage of the moment. They know that Russia needs a market for oil, for cheap energy, for cheap exports. And so China's fully taking advantage of that. But I think the sort of, performative bromance relationship that we kind of see highlighted a lot, I think that's a bit overstated. I mean, to me, if the war in Ukraine, if Russia itself just becomes too much of an albatross for China, I don't think they're going to stay buddied up in that way. Or again, they'll use it to their advantage. To me, China is very savvy about being very nimble with their relationships, taking advantage where they need to, but being able to pivot out and have lots of other options to turn to when it's not going in their direction.
We used to call things like this, I think, wolf warrior diplomacy out of China. Julie, is this a return of that?
Well, I'd say probably a little bit. I mean, right now, I think China is figuring out what their new diplomacy is going to look like. They've never really been at this kind of place where they have this much maneuverability, where they have this much strength, at the same time coupled with, again, coming out of COVID and trying to find their footing again. They have a lot of influence in a lot of parts of the world where they didn't before, and they just quite literally have many more options in front of them.
Great to catch up, Julie. As always, thank you. Julie Norman of UCL. If you are just tuning in and you're unaware of the events over the weekend, some remarks from the Chinese ambassador to France, to French TV over the weekend, that ex-Soviet states don't have sovereign status as independent nations, some uproar in obvious places across Europe. And the response this morning from the Foreign Ministry spokeswoman of China saying this: China respects the status of the former Soviet republics as sovereign countries after the Soviet Union's dissolution. Tom, it made a lot of headlines over the weekend.
Oh, it's a history lesson, and it goes to what Mr. Putin actually says. You have to look at what comes out of his mouth in these speeches, and they're always in Russian. Maybe it's lost in translation, but he harkens back, I would say, not late Soviet, not middle Soviet, but his blame on early Soviet Union expertise to an empire that he desires to honor and to rebuild. That's the Putin approach.
What Julie just said there, though, was that basically China is looking to curry favor with Russia, and that might have been an attempt to do that, to basically give a nod to them and say, actually, we're more on your side than it may seem, and then walk it back and say to the Western, perhaps Western nations that are perhaps a little bit more upset about this alliance, saying, no, it was a slip of the tongue, and trying to play both sides, which gives you a sense of how tenuous this dance they're trying to do is.
They're currying favor, except Tim Cook's flying around in India, in China, creating that tension, and people in China want the latest Apple toy. I'd go, John, back to LVMH,
sure,
what is made clear Hong Kong is not where it is, and the Arnault family is going to move across all the major cities of China as far out as Pandaland, Chengdu. And they're going to go out to Chengdu and do the Louis Vuitton thing and the rest of it. And that's just as important to me as the geo-diplomacy.
Well, the Treasury Secretary put it pretty simply in the last week, didn't she? Yeah. When Janet Yellen turned around and said there will be no decoupling. Yeah. You mentioned the Arnault family. The Arnault family does not want decoupling between Europe and China, that's for sure, based on their numbers.
A name Bloomberg Surveillance knows, Catherine Mann owns the high ground on this codependency and linkage of business China with business America. Does that trump all, not to use a pun?
Well, the link between business Europe and business China is going to be very, very tough to break if indeed they even try to sever it. Your equity market on the S&P 500, negative 0.1% to kick off a brand new trading week with a lot of earnings coming up. Slowly moving off the bottom this morning, your equity market almost unchanged now on the S&P 500. Welcome to the show on TV and radio. This is Bloomberg Surveillance. We're negative not even 0.1%, unchanged on the Nasdaq, almost flat on the S&P 500. Outside of that, into the bond market, the 2-year yield north of 4% for the whole of last week. We stay there. We're down a couple of basis points to 416.28. Mentioned a few times the Fed goes quiet now, going into their Fed decision next week on Wednesday, teeing up a 25 basis point hike from the Federal Reserve, Tom. And then what?
I remember when it was quiet. You know, it was, there's only the Oracle.
You didn't
Alan
need a quiet
Greenspan
period,
spoke.
it was just quiet.
He's carrying a ham and cheese sandwich today.
The briefcase looks heavy.
Yeah,
that kind of thing.
That was the mystery then. But you're right, John. I'm glad you mentioned. We got to get to May 3rd, and the jobs report is after that. Like we've got a GDP report now.
And before we get there, May 4th, the ECB with the euro north of 110, and everybody lining up to say the same thing about the European Central Bank. Lisa, the ECB is going to hike more than the Federal Reserve this year. Seems to be the direction of travel, which is why we've seen such a big move in the euro off the lows of the end of September last year.
Would you say that the most consensus trade right now is long euro dollar?
Yeah, and overweight European equities relative to US. Mislav Matejka at JP Morgan, they start their week writing about exactly that. And they finished with this line here. Here it is. We think the time to take profits on the trade is approaching. Overweight Europe versus the US. And there are a lot of consensus trades out there, Lisa. We talked about the overweight of Europe versus the United States, and within the US, tech versus everything else, and you wonder what gives.
So the contrarian trades kind of start to emerge. Let's take a look at some specific names. We were talking about Coca-Cola and shrinking cans of soda, and they did report their first quarter organic revenue growth that dramatically surpassed expectations. I believe up about 12% in the quarter versus 9.6%. That was the estimate heading in. Those shares not up that much. I think that's interesting. 1.4% gain. Those shares are basically range bound so far this year, up only about 1%. So even some of these stalwart consumer names, not exactly doing gangbusters so far this year. UBS shares, this is interesting. The ADRs, the rising about 1.6% ahead of the open here. This comes on the heels of what we saw from Credit Suisse. John, you said this, that it doesn't seem like all that much, $69 billion of outflows relative to the sudden emergency rescue. Maybe this means that it'll be easier for UBS, Tom, to acquire Credit Suisse and make it work.
And they're tomorrow, and they're going to speak to the Swiss people, as Manus Cranny did in his bang-up report last hour. But the bottom line is, do they drop a bombshell tomorrow and say, here's our first layoff number, our first right-sizing number, our first rationalization number?
Sorry, Lisa, go on. No, please.
I would just say that the one bombshell, in my opinion, would be if they gave you a new framework for how long it would take, and it's a lot shorter. If they might get a sense of that.
I think the PR story is going to be fascinating, because if their inflows look tremendous relative to Credit Suisse's outflows, and you put a number on Credit Suisse, what number was it in the end? I forget. So many weeks ago. No, I mean what they paid for it.
They paid $3 billion, and
whatever it was. Credit Suisse and UBS. UBS tomorrow has got to come across as the saviour of Swiss banking, and not someone that got a mega deal from the regulator in Q1.
Just want to give you one more stock.
Sure.
Bed Bath & Beyond. They filed for bankruptcy yesterday.
Is it finally done? It's not a meme stock this morning?
It's not. Well, it's a meme in terms of how quickly it's going down. It's down 40% in pre-market trading. It is going to file for bankruptcy. It did file for bankruptcy, but it's also, this is really key, it's going to liquidate all of its stores and the buy baby shops.
Years.
Well, but this is the issue, right? We also saw that with David's Bridal. They filed for bankruptcy.
What?
David's Bridal. It's a bridal
Is that
store,
like Susan's
shop?
Divorces?
Okay.
It's a great store.
All right, I'll let you discuss that in a second. But I do, go for it. But I do think that this is interesting. Also, if they don't find a buyer imminently, are going to close all their stores. This is different.
Can we pause here? Ed's over here.
Susan's
Ed's over here
I mean, I'm almost crying.
So much. Can we pause here right now? This is really.
Leave.
How many kids sitting on a couch with a laptop lost money on this garbage doing the meme thing? I just wonder how much money was lost by people doing the meme thing with Bed Bath & Beyond. I just really wonder.
I just wonder if people are going to miss going in on those long shelves just going up to the
ridiculous.
ceiling, covering all of the very industrial fixtures. That was their whole thing.
There's clearly some brand value in that name still, Tom.
Yeah, okay.
Be interested to see what happens with it.
Yeah, it'll be.
But I think a lot of people said the same thing about Toys R Us
and Blockbuster.
Yeah, so there you go.
Okay, well, let's jump forward here. We're going to do this at 60,000 feet with Ed El-Husseini, senior interest rate strategist at Columbia Threadneedle. And I love how he finds a more strategic tone to your reset for this tumultuous 2023. A 2023 on timing, scale, and scope. I love it. The magnitude and the timing all tied together. What is the timing, scale, and scope of Jerome Powell as he confronts the rest of the year?
It's a tough juncture. There's so many unknowns, and in some ways, if you look at what's happened over the course of the past 6 months, the degree of doubt around what's driving inflation, how quickly monetary policy from last year will finally constrict the economy, and now what's going to happen with the evolving banking shock has amplified what the Fed's facing. So in many ways, the doubts at the very core of the Fed's reaction function at this point.
There seems to be some confidence that inflation is going to come down. There seems to be a debate about what price we'll pay for it. Can we talk about the thing we're confident about? Do you think we should be confident that inflation's going to return to 2% anytime soon?
I think there's a really good chance that that's going to be the outcome. The question is, what's the time frame for that? Right, the Fed's in scope for that to happen over the course of the next several years. If you look at market pricing is exceptionally confident that that will happen as early as the end of this year, beginning of next year, if you look at CPI swaps. And so the direction of travel, in my mind, is clear. The Fed's conviction around bringing inflation down to 2% is very clear, but the timing is a huge question mark.
There's one other inconsistency, something I struggle to reconcile. We've priced in all these rate cuts. At the same time, people have this view that we get this soft landing. Why would the Fed cut rates in a soft landing scenario?
If you look at market pricing, it's essentially a probability-weighted, view of the world, right? And so the Fed cutting 25, 50 basis points before the end of the year, there's a much higher probability that the Fed's going to cut 100 basis points if there is an accident, or cut zero if inflation is sticky. And so what you see in market pricing is a weighted average of that. Now, will the Fed cut in the event that there's a soft landing? Really what matters is that they have conviction that inflation's coming down. If inflation's heading down towards 2%, rates at the moment are too high. If it's stuck above 2%, let's say 3.5%, right now it's running closer to 4%. The odds that rate cuts will be on the horizon this year are quite low.
What kind of accident would be enough to actually make the Fed cut rates?
In my mind, the labor market is key to this question. We are starting to see some signs of slack at the margins of the labor market. Wages have started to slow. We're seeing unemployment claims creep up. But so far, it's been a picture of overall health. The labor market tends to turn very quickly. And so if we start to see the unemployment rate creep up, if we start to see wages decelerate towards the end of the year more than they've done over the course of the past 12 months, that would be a really strong signal to the Fed that they have done enough.
But that's not an accident, right? I mean, that's basically the design, is to get unemployment just up a bit higher, or at least so that there have some slack in the labor market a little bit more to bring inflation lower. If this wasn't enough to get the Fed's attention, I mean, yes, they did flick at the Silicon Valley Bank and what happened there, but it seems to be contained. If it really is contained, has the idea of an accident been sort of taken off the table?
That's a really good question. In my mind, the accident really comes through the lens of financial conditions. So if there's a disorderly widening of credit spreads, a disorderly change in the liquidity conditions, particularly for treasuries, you will see the Fed act and at least bring forward the easing cycle. Now, are those things predictable? Mm-hmm. No.
Let's do a basic fixed income Monday morning retail question. Now that I garner a coupon, nominal or real, can I own longer duration, grab the coupon out there, I don't know where that is, and wait, and even if I see price go down, I've still got that coupon? Are we back to that mindset?
I think it's very attractive. I mean, look, the key question for a retail investor is, am I going to park my investment in cash, which is now quite attractive, versus longer duration assets, whether it's high quality credit or treasuries. And we think that extending that duration right now.
Give me a number, roughly.
Anywhere between 3.5% and 4% on the 5-year note is quite attractive. And then you can add to that if you're looking at credit.
This is really important, John. The idea here of a pro like Ed is looking at a 5-6 year duration, where in muni bond land, 20 years is short term because you're grabbing.
If I can take one thing away from this conversation, Ed, what you said about the market pricing cuts being a weighted probability, a weighted average of a range of views, I think is so important. Gershon Distenfeld of AllianceBernstein talked about exactly the same thing. This means that either we've priced in too much or not enough. And Lisa, I think that's the problem that Neil Dutta basically has over at RenMac. And Neil's saying the same thing. And Neil, by the way, is much more constructive on the economy than a lot of people out there saying recession. It's basically saying that if you do have a financial accident, which is what you're talking about, Ed, they're going to go way beyond what's priced in. But if nothing happens, they're going to hold and do exactly what they say. So I wonder, Ed, how much we're making of this gap between the Fed and market pricing. Do you think we're making too much of a big deal of that? That spread between market pricing and the Fed?
I think that's exactly right. It's not a big deal. I think maybe there's a little bit of a gap between terminal pricing, which is another 25 basis points of effort that the markets have given to the Fed. It's possible that they go a little bit more. Inflation's been moving sideways for the past 4 to 5 months. But beyond that, what markets are pricing, to me, seems quite reasonable. It probably puts the front end of the Treasury curve. It makes that a little bit rich. But the moment you get to the 5-year, you get to the 10-year point on the curve, those look quite attractive to us.
Ed, always smart. Great to catch up. Thank you, sir. Ed Al-Husseini there of Columbia Threadneedle. Lisa, what do you make of that? We've either priced in too much or not enough.
What it makes is that we're in a soup. And right now, even what people are trading in market pricing is trading around these sort of ambiguities of we have no clue what shoe is going to drop next. And if no shoe drops, well, then we're actually in a pretty strong economy. And we could get no recession and no need, or it's just a really light recession. So it's just a messy moment where people don't know what's happening. And Peter Scheer wrote it right, which is basically road to nowhere. He's like, I'm not even angry enough to write because I've got nothing to write about, because it's basically this range-bound soup of nothingness.
Not angry enough to write is the title of Peter Scheer's research note this morning. I love Pete. Coming up, 8:30 Eastern Time, in about 50 minutes from now, we'll catch up with Dana Peterson of the Conference Board on the Economic Outlook, Tom. That's just around the corner.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Possible presidential candidate Ron DeSantis met with Japan's Prime Minister Fumio Kishida in Tokyo. It was a chance for Florida's Republican governor to burnish his foreign policy credentials. DeSantis said he appreciated Japan's efforts to boost its defenses. Japan has increased military spending, in part due to China's threats toward Taiwan. In the UK, Prime Minister Rishi Sunak's government will try to fill the void created by the implosion of the country's main business lobby. Sunak meets today with about 200 of the UK's major business leaders and investors. That comes after dozens of companies quit the Confederation of British Industry. There have been allegations of rape and sexual misconduct against CBI staffers. The U.S. reportedly has asked South Korea not to boost chip sales to China if Beijing bans U.S.-based Micron from selling there. And that's according to the Financial Times. Beijing has launched a national security review into Micron, one of 3 dominant players in the global DRAM memory chip market. South Korea's Samsung and SK Hynix are the other 2. LVMH has become the first European company to have a market value of more than $500 billion. A boom in sales to China and a strong euro have boosted the luxury goods maker. LVMH's rising value has turned CEO Bernard Arnault into the world's richest person. According to the Bloomberg's Billionaires Index, he's worth about $212 billion. And Credit Suisse reported $69 billion of outflows in the first quarter. It also took a large write-down at its wealth management unit. All of that underscores the challenge for UBS in retaining key clients and assets following the emergency takeover. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
the Fed is tiptoeing through a dark room where they know there's broken glass on the floor, they're going to be a little more cautious even if they go beyond May. That for us, from a distributional sense, it cuts off the right-hand tail side of the US dollar smile. So the only way to get USD meaningfully higher is starting to price in recession, and we of course don't think that's an imminent factor.
Luke Howard, just phenomenal as always over at UBS Asset Management, a good friend of ours, a good friend of the program, of course, looking for a stronger euro, outperformance in European equities. That's where the outperformance has been. Let's be very clear about that. Against the S&P 500, the Euro Stoxx 50 since the end of September, absolutely crushing it. The equity market more broadly right now is negative 0.1% on the S&P 500. I've given you the guide for earnings for the week ahead a few times, but I'm happy to offer it again for big tech. A little bit later this week, tomorrow, Microsoft and Google. Wednesday, you'll hear from Meta. Thursday, Amazon. Next week, Tom, Apple.
I miss Luke Howard.
Luke was great. He was awesome. He was brilliant.
Well, he's always awesome. We know that. I mean, he's the youngest, brightest guy we know. But this may be the year where the Leafs have a pulse. The Toronto Maple Leafs
he wanted to talk about that.
Are like the Tottenham of hockey.
Lisa and I maybe not
I know.
the appropriate people to discuss it with him, Brahma.
Disappointed that you weren't there.
They've taken 2 from the hugely wonderful Tampa Bay Lightning. Good morning, Jeff Vinnick. And the answer is maybe this is finally. I don't think Luke has ever seen the Maple Leafs win. I mean, I don't think.
Well, he was happy. Let's put it that way.
I think.
And the Knicks got it done yesterday, right?
The Canucks did, yes.
The Canucks. You're calling them the Canucks.
Yeah.
Okay, good.
Just for
all right.
It gets very rich.
Basketball experts around this table as
Thank
well.
you. Whoa, we're just so knowledgeable. Let's go to someone who knows what they're talking about right now. Stephen Englander with us. We had Jens Nordvig with us earlier, and we go stronger with Stephen Englander, global head of G10 FX research at Standard Chartered Bank. Stephen, I got to go to 60,000 feet. I saw it in The Economist this weekend. It's out there. The death of the dollar. You were a child, and we were talking about the death of the dollar. How close are we to where we would lose the power of the dollar as a controlling exchange?
Well, first I have to talk about important things. Since I'm from Montreal, I think the Maple Leafs have gotten just what they deserved the last 30 years.
Bam.
With respect to the dollar, I think that any kind of de-dollarization is going to be limited and very slow. On the other hand, we see the business cycle turning against the dollar. We've seen European equity markets and global equity markets for the first time in years outperforming US equity markets. And we do have this, concern in a big part of the world about how safe their dollar assets would be in the event that there's a geopolitical issue with the US. So a slow process of de-dollarization doesn't necessarily mean a slow process of dollar weakness, because the US still has its funding requirements, and all you need to do is have less money coming in.
For our corporate audience who have to hedge every transaction every day for safety, is there value to hedging foreign exchange transactions right now, or is it money wasted?
Look, there's always value. There's always prudence to having some hedges on. I mean, once or twice, FX strategists like me have been wrong in our forecast, more than once or twice. So I think just to lower the volatility of your earnings, you want to have hedges. But I think that even at 110, the dollar has room against the euro. The dollar has room to weaken. So maybe it's a story of hedging a little bit less. If you're at your normal hedge ratio, you don't, you shade it a bit.
I'm looking at the idea of central banks and whether they turn to the dollar as a reserve currency, and sort of to build off of what Tom was talking about. There was a story in the Financial Times over the weekend about how gold purchases by major central banks have risen to the highest going back to 1967. And you can see that a lot of them are planning to continue to build gold resources. Do you get this sense that there is this sudden concern on the part of major central banks about the use of the dollar as a reserve?
Well, I don't know if it's a sudden concern. I think it's intensified. We started, I think, about 20 years ago with sanctioning Sudan, and now the use of sanctions has obviously broadened quite a bit. I think any country that thinks that they might be on the receiving end down the road of U.S. sanctions, because it's not as if you can get out of dollar assets quickly, would sort of haircut, discount their dollar assets and try and avoid them if they can. It's not as easy as it looks, but on the margin, I think that they are looking for alternatives.
Given that, Stephen, do you think that there is a sort of weight on the dollar that hadn't been there before, that where it cannot rally quite as much in periods of global concern or recession, just simply because it isn't necessarily going to be the go-to place for all of those central banks?
Well, people toss around the word recession, and including me. What I think most of us are looking for is sort of sluggishness, maybe a technical recession, but, nothing that looks like the middle of 2020 or 2008. And with that kind of sluggishness, I think you're still going to be on the dollar weakness part of the dollar smile. But I think on top of that, you have all these other factors, including the, outperformance of equities. For a long time, the attractiveness of the U.S. equity market has been a major sort of force bringing money into the U.S. Now there may be better places to do it, in addition to the geopolitical issues, in addition to, the debate being about the Fed pause and when they might begin to cut. Dollar's kind of expensive to have all that weight on it right now.
Stephen, the Standard Charter mandate is a mandate of emerging markets, the Pacific Rim. There's a whole romance to the history of the bank. Which lesser EM currency now gives me the best big figure return?
Well, in Asia, we like Indonesia, we like Malaysia, we like the high yielders. We think that those are going to be, attractive. In emerging markets, we like Brazil. In Latin America, we like Brazil, high yielders. ZAR has gotten beaten up, but it's, if the world outside the U.S. is recovering, it's likely to do better down the road.
Hey, Steve, appreciate it. Thank you, sir. Steve Englander there of Standard Chartered on the FX market. Lisa, strong euro, weak dollar's been a theme. You go back to the end of September. What were we on euro dollar? 95?
Yeah, it was
something
insane.
Like 95. We've been talking up cable parity.
We're up 14
the pound
big
against
figures.
the US dollar.
14 big
It's
figures.
a monster move.
Yeah.
And risk has moved with it. I think that's what's really interesting. We had that stress around the end of September. Really, really strong dollar. Equity market weakness started to come through as well. And then that started to resolve itself.
And how much is this because of energy and what happened with the stockpiles, the perhaps warmer than expected winter? And how much is this just simply China reopening, putting all this money into the European economy, them being a bit behind the U.S. in terms of the fight of inflation? You put that together, it kind of makes sense.
Steve Englander alluded to it, and that we spend, in the financial media, we spend most of our time looking at interest rate differentials. What's the ECB going to do? The usual central bank parlor game. Steve Englander is there talking about flows of money. This is something Robert Sinch was legendary at Bank of America, and before that, Bear Stearns. And the flows of money have been, I got to buy Apple. So, it's a generalization. So the money flows into the United States. Is that flow or that marginal flow broken is maybe the big question 12 months out.
I think we've heard the reference to the dollar smile a couple of times now in the last 5 minutes. We should probably get Steve and Jen on one day to talk about it, Tom, but I think we can discuss it now. On the one side of the so-called dollar smile, you have that US exceptionalism story, dollar strength.
And
on the other side of the smile, you have everything really, really bad, dollar strength.
Yeah.
It's the everything else bad part of this that people aren't confident about. And I think Luke Cower talked to that. He said you can have a situation where the US growth slows and you don't get a stronger dollar because the rest of the world still is okay. If China, Europe gets into trouble, then we've got a different story. But they just don't see it happening yet, Lisa, because of the growth we've seen in China off the back of the reopening.
I'm going to say something a little sacrilegious.
Sure.
Macro stories right now, I'm having a really hard time with, because you can kind of come up with whatever macro story you want when you say things are going to be bad. Well, in what areas, right? To that point of, okay, well, if you have something that's bad in manufacturing but not in services, things can still be okay. Like, what will qualify as bad enough? So you can paint a narrative and use the data and get a completely different market reaction, and that's just mind-bending right now.
I think there's tons of narratives out there. Let's remind ourselves, Steve and Jen, iconic at Morgan Stanley years ago. He's sort of often, what are you going to call it, John? Hedge fund land? We don't see him as much. But he's talking up de-dollarization as a concept out 3 years and 5 years
I remember doing a conference with him years and years ago, and it was just an absolute clinic
Oh, yeah.
The guy is awesome. Should try and catch up with him again soon. Drew
Next
Madison,
trip to London.
MetLife, coming up from New York with your S&P 500 negative about 0.1%.
There's a lot of fears of the carryover from the banking crisis and things were going to fall apart. That's not the case.
I think overall we're starting to see some stabilization.
Our view is that the Fed is going to be torn, really torn, between inflation north of 2%, but the unemployment rate starting to rise.
When I think about the Fed, I mean, they're closer to the end of this than not.
If the Fed's cutting, the economy's not so good.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on television and on radio. A Monday towards an earnings season, towards a Fed meeting along the way. And John, I'm sorry, I look at this Monday. It's a 12% organic growth. What will be the other surprises this week in earnings?
Well, there's tons of earnings to look ahead to. Thank you, Stuart Kaiser of Citi, for this number. More than 40% of the market cap of the S&P 500 reporting this week. Mega cap tech, a part of that story. I am interested, though, in one specific thing around the earnings story. Putting some numbers on the drama of the last quarter. We did that with Credit Suisse a little bit early this morning. We'll do that with UBS tomorrow. First Republic after the close, Tom. The last significant name, I would say, from the drama of the last 3 months to report earnings in the banking sector.
And the Keefe Bruyette Index clearly shows regional bank tension. I looked this morning at the big cap equity bank chart and the regional smaller bank chart. Two different worlds.
There are all these little inconsistencies, TK, that don't really stack up. Brown, you talked about a low VIX. VIX has recovered. It's come in. Yet you also talked about the financials. They haven't recovered. They haven't rallied in quite the same way.
And as Tom pointed out, particularly the regionals, even after you've got numbers, as you've said, John, that haven't been really that terrible. There haven't been massive, horrible surprises that weren't already priced in. But on the flip side, there wasn't anything to really give people optimism that the business model wasn't profoundly flawed at a time when these banks would have to pay up for deposits.
We're going to reset. And for all of you, we've got a guest coming up here in moments. It will really help with your reset of your 201k if you didn't participate in this market. John, I didn't realize walking in the door after my sojourn, this idea of 12 months trailing Standard & Poor's, Dow, and NASDAQ. I think we're all set. I'm set with a gloomier outcome than what the number really was. SPX was negative 27% at the bottom, now negative 3%, Dow 0, flat. NASDAQ has really come back near an SPX 1 year trailing.
Oh, the rally has been phenomenal. Looking at the NASDAQ year to date, Tom, we've seen a massive move on the NASDAQ year to date. Year to date, currently, I think we're up about 15%. You look across Europe, though, CAC 40. How many times have we talked about that? I don't think you and I have talked about the CAC 40 once in about 5 years, Tom. Maybe a couple of times. We've done it a couple of times this morning. LVMH makes up more than 10% of the index. LVMH earlier this morning, $500 billion company. First time we've seen that in Europe. CAC 40's up 20% year to date.
We inform on Bloomberg Surveillance, and we do this with the idea of the CAC 40. I didn't know it only started in 1987. It was an index in Paris before that. And then they went to some form of like digital trading or whatever back then. And I can't say the French name. The cotation assistance with accents we don't have en contenu. How am I doing there?
Don't ask me.
I just want to point out how connected this could be, that we're talking about the CAC 40. We're talking about French luxury companies and how they're doing tremendously.
In China,
And Macron's in China.
I don't think it's
having, a really nice discussion about trade with Xi Jinping. You put these things together. I mean, are they totally separate? I don't think so.
I don't think they are at all.
Switch gears quickly here before the data check. Jens Nordvig, Stephen Englander, back-to-back. That's what this is about. John, on the euro, can we get belief? Jordan Astavila at another bank, he is looking for a 115 euro.
Let's be clear. We've got belief. We've got the belief. Yeah. It's about whether the moves materialise. So far, they have. But we have to go back to the conversation that Mislav Matejka started at JP Morgan this morning. Are we approaching that point where it's time to kind of close out the move, Tom, close out the position? You've seen a massive move. Consensus overweight Europe, we get it. Consensus long the euro, we get it. We've seen some big moves already. Is it time to close the position?
Week yen, euro yen through 148 this morning, John's a benchmark for me.
Let's run through it on the S&P 500, negative 0.1% on the S&P futures, just a little lighter, no drama here. Yields come in 3 basis points, your 10-year 354. Talked about a euro through 110, just about holding on to 110 right now. That currency pair, positive 0.1%. And crude back in the 70s. not really doing much this morning. 77.80, Tom, on WTI.
Right now, and this is lean forward for global Wall Street and those of you that need optimism. Drew Mattis joins us, Global Economics and Market Strategy Head at MetLife Investment Management, iconic with Maury Harris at UBS for years, with an optimistic tone on the American economy. Buried in your note, you go to the heart of the matter. Olivier Blanchard says this in my book of the summer. Paul Romer, the great Nobel laureate, is big on this, and the Nobel laureate Drew Mattis mentions it as well. We underestimate the technology overlay of the United States of America. You have a more optimistic tone on risk right now, and part of it's because of our technology leadership.
Well, I think so. I think, so first of all, we have a recession to get through. I mean, I think everyone who was saying there wasn't going to be a recession this year is now finally kind of throwing in the towel on that. It seems obvious that there's some downward momentum in the economy. The question is, when we come out of it, what's it look like and how good could it be? And what I've been arguing is actually it could be as good as what we saw in the 1990s. I think you're going to see, when we come out of this recession, you're going to see a return of a higher labor force participation rate. You're going to see older workers returning. You're going to see workers staying in the workforce longer because they're going to be healthier. And you're going to see the productivity gains from all the technological advances we've made during COVID.
What do you think the catalyst to return will be?
I think the catalyst to return will be a couple things. One is people are trying to figure out what to do with 35 plus years of retirement, right? I mean, so as lifespans continue to kind of improve, do you really want to sit around the house for the last 35 years of your life? I think more and more people are going to say the answer is no. Secondly, what can you do with the money you've saved for 35 years? Well, you can do a lot more of it in 25 years than, if you work an extra 10. And I think people are going to generally be healthier. I think we're seeing significant improvements. From the time I started work, people were promising biotech miracles. And it was just like, oh, yeah, there's going to be a biotech miracle next year. Oh, no, maybe the year after. We actually saw some of them. And we've all been so distracted by everything else going on in the world that we haven't recognized the fact that there have been significant improvements in how we're able to actually change kind of, what goes into your body, how to fix things, and how to kind of make people healthier.
So people will live longer.
Yes.
And they're all faced with a decision. And clearly it's not going to be golf is really hard and I can't play golf. You think it's going to be something else. I'm trying to work out why it wasn't 5, 6, 7, 8% inflation, why it hasn't happened in a major way over the last couple of years. Why is that?
I think, one of the reasons we haven't had inflation was because no one expected inflation. So inflation is one of those quirky things. If no one believes inflation can happen, then it won't. And it really takes a mindset change to allow for inflation to occur. And this is why hyperinflation happens in certain countries, because people just are like, it's not unusual for the price of something to go up 1,000%, right? But, what are we seeing now? Actually, we're seeing prices going down in a lot of categories. I think, our flirtation with kind of high inflation is coming to an end. I think before the end of this year, we will be at a level that's pretty consistent with long-term inflation expectations that the Fed wants people to have. And we will be able to kind of move on and maybe learn from the experience. Hopefully the central bank will learn from the experience that the next time inflation's running really hot, maybe continuing to ease is not the best idea.
Given the fact that yields are a lot lower than where they were, say, 2 months ago, but still significantly higher than they have been over the past few decades, are you just going heavily into fixed income right now, saying that this is a great time to capture these yields if this is simply a flirtation with inflation?
I think you actually still want to wait a little bit. What tends to happen is you want to basically start looking at riskier assets when everyone else doesn't want them, right? And so that tends to be at the start of a recession, when people are trying to kind of, the people who were convinced themselves that a recession could never happen, unemployment could never move higher. That's what you want to buy when they're selling.
So what do you buy right now? I mean, just sort of stay in the big tech that's done the best?
I think you actually just, like a squirrel waiting for winter, you just gather your nuts and pile them in a tree. So cash looks pretty good right now. I don't think now's the right time to take a huge amount of risk because I think prices will get a little better as it becomes more obvious that recession is coming. You're seeing hints of that, right? You were talking about the VIX earlier, Jonathan.
Sure.
Part of the reason the VIX is going down is because everyone's coalescing around a view. And if there's not a dispersion of view, then the VIX actually begins to calm down a little bit. And so the view is actually, congealing, I guess is probably not the right way of thinking about it. But the way I cook, it's probably the right word to use.
Defense and playing defense. How expensive is that getting?
Well, I mean, it's not cheap. But at the same point, you can play defense actively or you can play defense passively. And so the cash idea is playing defense, passively, and you're actually getting compensated for it.
Drew Mattis, MetLife TK. Great to catch up with Drew. Always is.
Yeah, it's a bigger view. I mean, it's the economics of Drew Mattis combined over to the market strategy of it, what it means for equity. And, when I look at MetLife, it's like a longer-term view. Their idea of short-term is 3 years. And that's not something we're used to in financial media.
Back to the 90s, I wanted to put that together with what we heard from the IMF last week about returning to pre-pandemic interest rates, Lisa.
And this is where some people are. You wonder how much this is actually baked into market expectations in terms of how much disinflation has to go, and then going into the sectors that benefit the most from ultra-low rates on that bet.
And people are still talking here, days on, almost weeks on the IMF 5-year view of economics. I mean, it captured the attention of optimists and pessimists alike.
It was a bizarre meeting, wasn't it?
Yes, that's an act. I would say that. If the managing director was sitting here, I would say it was a bizarre meeting. How do you move forward to Marrakesh in October? And the answer is they've got to reset. And, of course, the events will be so much of how they reset, particularly with frontier economies that are so
We need to reset as well, looking ahead to the tech earnings later on this week, and then on to next week when we get a Federal Reserve decision and a payrolls report as well for the United States. We're going to be catching up in about 20 minutes' time with Dana Peterson, the chief economist at the Conference Board. Looking forward to that conversation. Before we get there, here's a snapshot of the equity market for you, just briefly on the S&P 500. We look a little something like this. We are negative by not even 0.1%. Yields are a little bit lower by 3 basis points, 353.94. For those of you looking for Fed speak, there won't be any. Yes. We are in a quiet period for the Federal Reserve.
Is there an auction?
And for those of you tuned in all morning wondering why I'm repeating that, it's because we're so happy about it. Just so happy about it. From New York City, we complain if they didn't speak. We complain when they do. This is Bloomberg Surveillance.
That's like our tag.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy says the chamber will pass his $1.5 trillion debt ceiling increase this week. Still, Bloomberg's learned that McCarthy hasn't yet lined up all the votes he needs. McCarthy told Fox that President Biden must negotiate in order to avoid a U.S. default. Last week, the president called the Republican plan wacko. Another blow to France's President Macron and his push to enlist China's help on the war in Ukraine. China's ambassador to France told French TV that the former Soviet states don't have sovereign status as independent nations. Those comments triggered furious reactions, especially in the former Soviet bloc countries Estonia, Latvia, and Lithuania. China has now backtracked and says it respects the independence of those countries. In Sudan, the international effort to evacuate diplomats and other expatriates picked up over the weekend. U.S. and U.K. militaries were able to airlift their officials to safety. A temporary ceasefire between Sudan's army and the Rapid Support Forces militia that has battled since April 15th appeared to have failed. Coca-Cola has posted first-quarter revenue growth that beat estimates. Consumers were willing to pay higher prices for Coke sodas, juices, and energy drinks. In North America, the average price across a mix of products grew by 11%. And it's the end of the line for Bed Bath & Beyond. The home goods chain will close all of its stores and liquidate inventory over the next 2 months. A turnaround attempt failed, leading the company to file for bankruptcy protection. Bed Bath & Beyond employs about 14,000 people in the U.S. and Puerto Rico. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Just about every single regional bank increasing their provisions for credit losses. And some of them had even released them a couple of quarters ago. And so that's certainly a big sign that all of these banks are preparing at worst for the beginning of a recession or at best for a softening of the economy.
Things aren't great. They just aren't terrible either, so it depends on what you expected to begin with. As always with earnings, that was Mara Rodriguez Valladares of MRV Associates, live from New York City, going into a big week for earnings. Bank earnings a little bit later. First Republic, the one to focus on. We'll get to that in just a moment. Then on to tech through the week. Going into it, your equity market really not doing much last week and this morning. Last week, I think negative 0.1%. This morning, negative 0.1%. Yields down 3 basis points, still in and around 350. Dare I say we've stabilised a little bit, Tom?
Yes.
In the market.
Across
just
asset,
a bit.
looking at equities, bonds, currencies, commodities, it's not a snooze fest because the news flow is extraordinary, but stabilization captures it perfectly. Maybe I'd look at dollar Mexico, 18.03 shows you that stability this morning.
Looking forward to the earnings a little bit later. First Republic had a really difficult first quarter. We'll put some numbers on that difficult first quarter, Tom, this afternoon.
Well, why don't you bring in Herman Chan? Let me tell you who he is, folks. You want to lean forward on this global Wall Street. He's with Bloomberg Intelligence on regional banks, but far more, John, this is a guy with multiple bank experience, including the privilege of working for M&T Bank, Mr. Wilmer's shop of Buffalo, New York. That makes him knowledgeable like we aren't.
Herman, this is a pleasure. So give us some knowledge. First quarter, terrible for First Republic.
That's right.
Face some real existential risks, some panic there at times. Put some numbers on it. What are you looking for a little bit later?
Yeah, sure. What we're looking for is more on the guidance because we know the first quarter is going to be a challenging quarter for them. What's happening with the deposits? Have they stabilized going towards the end of the quarter? And what's their plan? Because they need a way forward if there's a big hole in their balance sheet. Are they going to be selling some loans and assets to shore up and resize the balance sheet? Are they going to look at other strategic opportunities? So there's a lot of questions heading in the quarter, and management has an opportunity to answer those.
Give us a window into management. This was in the zeitgeist this weekend, in that a bank blows up, the old guys go out the door, and they literally go out and find, I guess, unemployed executives who are good people, and the new executives on the block come in to try to right the ship. What do they do with a bank they don't know anything about? The relationships they don't know anything about.
Yeah, the folks that you're talking about, former CEO of Fifth Third, he came in to shore up the Signature Bank. So there's a Rolodex of former CEOs that are out there that the FDIC kind of has on hold to come in and take over and lead an institution.
For the younger of you, a Rolodex is a little turny thing you have on your desk with names in it. You're too young, John, to remember.
No, I remember the Rolodex, Tom. I was born pre-smartphone. I was there. Lived it. Thanks, though, TK.
Thank you.
That was helpful. I will say, though, I did read that story about the Rolodex of former bankers. As we parse through some of the earnings, I am curious about how many of these banks are going to pass along the interest rate increases that they're seeing from the Fed to depositors.
Right.
And there was this one study done by Goldman Sachs that was published over the weekend where they said that every 10% drop in bank profitability reduces lending by 2%, and that this could potentially accelerate in a massive way due to this deposit beta.
Sure.
What are we seeing?
Yeah, so we're talking about deposit betas that prior to the SVB fallout was closer to around 35-40% of a all-in cumulative beta through the cycle of Fed rate hikes. So now the banks that we're covering are talking about 45 to 50% of the pass-through of the Fed funds to their depositors. So that just means that funding costs are rising and will continue to rise, and net interest margins are narrowing. So it does affect the profitability of these regionals, and it's something that we're watching really closely.
It's a squeeze on both sides, right? They're having to pay up for deposits, and at the same time, they're struggling with some of the loans that they have on their books. About 40%, I believe, of the smaller bank loan book is commercial real estate. I mean, how much are you getting a sense of what the health underpinning that really is?
Yeah, so on the loan side, there is some marginal concern that the commercial real estate exposure and office exposure will create some loan losses for the group, but it's going to be elongated. It's not going to happen overnight. It'll be a couple years because these loans do mature on a rolling basis. A couple of banks did raise their guidance for losses, for loan losses for the year. So the pressure is starting to come to fruition, but it is something that seems manageable at this point.
John, it's on the Goldman Sachs website, the Marcus website. Marcus, 4.75%, 12-month CD. Chase, next to nothing. Citigroup is less, 4%, 4.05%.
Yeah.
Bank of America, less than nothing. I mean, there are visibly out there Monday morning, if you don't know what to do with the next $10,000, a huge differential.
Two-tier banking system. And I don't think JP Morgan and Bank of America are going to even try to compete. They talked about those new deposits coming in last quarter and called them flighty. It was almost an expectation that they were just going to go away again and weren't going to stick around for long because there was concern underpinning those deposits that came in about return of capital. And then once they start to think about return on capital, it's just going to go somewhere else. Herman, can we finish with some scenario analysis, perhaps unfair scenario analysis? If one of these major banks, one of the major banks that Tom just mentioned, wanted to buy First Republic, how do you think that would go?
Yeah, it would need the regulator's blessing because they tend not to let a large bank like JP Morgan or Bank of America acquire regional banks anymore just because of the sheer size of these trillion-dollar balance sheets that they operate. So if First Republic were to be acquired, it would be a regional that would take it over, presumably. So that's the base case.
I can understand why the politicians would be unhappy with it. Why would the regulator be unhappy with it now? I know why they weren't previously, but right now, would they be okay with it?
Right. It's more of an issue with the global large banks that they don't want to make them any larger. And
don't we like that now, though?
I guess we do from a certain extent, but there are regionals that have the balance sheet to acquire them. So that's what we're looking for, if that would be the case.
Any names in mind?
I don't want to presume at this point, but there are a number of large regionals that do have the balance sheet and the capacity and the magic surveillance to absorb a bank like that.
Pre-pandemic, JP Morgan, $2.7 trillion. I think that's right. Pre-pandemic, $2.7 trillion total assets. It's gone up $1 trillion to $3.7 trillion. So they're getting bigger whether they acquire or not. I mean, these guys are embarrassed by their success. It's been one of my themes on these banks.
Well, honestly, the good news is you can speculate on how much the regulators don't want the big banks to take over the regionals, but the big banks don't want to take over the regionals because why would they have to take on the liabilities if they get the deposits anyway, which is essentially what JP Morgan did in this previous quarter.
That's a point very well made.
Thanks. I mean, I don't think they want them.
I agree.
I mean, no offense.
Got to do a bit of scenario analysis now and again, though. You know?
Well, it's true. But also to your point, we like big, right? That's the theme that we keep hearing is that there is a sense that the bigger banks are going to be more successful. And suddenly in Washington, they're the white knights.
They're the port in a storm now. And they were the problem 10 years ago.
I know.
That's always the way. Herman, thank you. Just wonderful, as always. Thank you, sir. Herman Chan of Bloomberg Intelligence. In the next hour on Bloomberg TV, great lineup for you to kick off this week with so many earnings coming up through the week. Sarah Malik of Nuveen, Dan Skelly of Morgan Stanley, Mike Schumacher of Wells Fargo. We're actually going to do something interesting with Mike Schumacher. We're going to talk about the debt ceiling, and he's not just going to say, we'll see when we get there. He's got some things to say. So looking forward to that a little bit later.
Is he gloomy? Like, does he really think it's like a serious...
No, I think we've all noticed that the mark's starting to adjust. Just the T-bill curve at the very front end. 1 month versus 2-3. It's just things are starting to happen.
Yeah. You're going to visit the land of Ira Jersey on this.
The very front end of the bill curve. And then I want to talk about really how that's going to spill out, potentially, if that tension boils over.
Can you imagine if some of the Congress members start talking about the T-bill market? If you look at the T-bill market and the curve inversion on the 1 and 3 month, you should be frightened. Everyone else is.
You know, thank you for watching in the Philippines today. Manila, I got an email from Manila. You're leaning back like this. This is like gathered David Brinkley. This is like what Brinkley used to do.
Why are you leaning back?
He would lean back like this. Brinkley would lean back like this.
Then you're off mic if you go back too far.
Well, it's okay. It's part of it. It creates a space in the room. Thanks for watching in Manila.
Space in the room. Do you think people want to hear space in the room?
Oh, yeah.
I think they just want to hear, Tom.
Bloomberg Surveillance, what an interesting Monday morning. Lisa, the conversation's been off the chart. I was out. I had the plague for a couple of days. I'm better thanks to the miracle of modern science. And, I missed a lot. But as you guys said, it's a snooze fest, but it's not. The narratives are uncountable.
The narratives are specific. They are corporate specific. We're getting some actual information about companies. Coca-Cola able to pass along a lot of things. We're getting on the margins this sense that perhaps things aren't as bad as we previously thought. We're getting just some marginal regional Fed data showing that the Chicago Fed National Activity Index actually came in a slight bit better than expected in the month of March, just a touch, still down, but still on the margins. We keep seeing this, whether it's corporations or in the data.
Tomorrow, a lot of real estate. My favorite, CoreLogic, S&P, Case-Shiller series. A little bit dated, a couple months behind, but we'll look for that. New home sales. And now we go to other economic data through the week. And it's a big earnings week, so stay with us for all that coverage. We're very excited about it. The tech coverage. How come the tech guys come out at 4 p.m. and the banks come out at 7 a.m.? What is that about?
You know, it's a good question. Remember that one earnings period where all of the big tech companies came out at the same time at 4 p.m.? You know, it's a good question. It's something that John feels very passionately about, that they should all come out after the bell and then give us time to really parse through it.
We feel that we need to parse through any good conversation with Dana Peterson, chief economist at the Conference Board, who really joins us now on the state of America. Dana, where's your GDP statistic that we're going to see this week? We sort of come down. We were all at 3.2-ish, and we've come down. Give me the Conference Board statistic that you're working with right now.
Well, we're probably looking at anything between 1.5% to 2% growth in the month. Certainly, we had a very strong January in terms of consumer spending, but then February and March were pretty pathetic. And also, we think business investment continued to shrink as well as residential investment. Of course, the wild cards are trade and inventories, which have been exactly wild.
Well, where's domestic final sales? If you take out inventories and trade dynamics, you get into a domestic view of Y equals C plus I plus G plus NX. And Dana, are we in domestic final sales recession now?
Probably not in the first quarter, but we do think that the second quarter, we definitely will see some negative readings. Certainly, that'll be negative consumer spending, also business investment, and of course, residential investment.
Dana, have you been surprised at consumer confidence hanging in there, at the fact that the economic data has not turned around more than it already has?
Well, our overall measure of consumer confidence continues to just kind of move back and forth. It's definitely down from where it was at the peak last year or even the year before. But still, no, when you look at expectations, consumers still expect a recession at some point, and they've been signaling that for the last 12 out of 13 months. And so something is about to happen. And certainly when we ask CEOs, they continue to believe that there is going to be a recession. It won't be long and it won't be deep, but it's going to happen.
How much is this consistent throughout industries versus specific industries giving this signal very strongly, whereas others are a little bit more iffy on just the prospect?
Well, when I look at the labor market and by industry, it's kind of split into three pieces. You have those former pandemic darlings that are not doing so well, like technology and retail and transportation, warehousing and finance. But then you have the ones in the middle that are just kind of hoarding labor and not doing anything. And then you definitely have those industries that are still adding workers, and that includes healthcare and hotels and restaurants, all those experiential types of services.
With inflation coming down, do we get an inflation-adjusted wage, however you want to define it, that's level or increases, or do we still have negative real wage growth?
Well, real wages are actually slightly positive right now, and that's because headline inflation has come off. But still, underlying inflation, less food and energy, is still pretty sticky. And again, wages are just slightly positive. So we think that with that, consumers are saying to themselves, well, you know, at least energy or at least gasoline's not as expensive as it was. And so it's not eating into my budget as much as it was. But certainly food and other services are still pretty expensive.
I look, Dana, at the back and forth here of all the economic data coming out. I believe we have to get to a Fed meeting May 3rd. What matters for Chairman Powell and the rest of the voters at the Fed towards May 3rd? Which part of the new economic data will matter?
Well, certainly this week's GDP report for the first quarter, but also the PCE deflator inflation, whether or not we still continue to see stickiness in the core, or if it's just a function of what we saw in CPI. And also daily lending data from banks to businesses and consumers, and seeing how much that dips. Because if it dips considerably, then that tells the Fed that, well, maybe this is the last hike that they'll need to implement. But certainly if inflation continues to be a problem, we might be looking at 2 more hikes.
We're speaking with Dana Peterson of the Conference Board at a time of great uncertainty of exactly where we are in this economic cycle. And Dana, there was a lot of discussion earlier in this year about whether we'd be going back to the low-inflation, low-growth kind of environment that we had for so many years and whether rates could go back to that in the next few years. Do you see that as a likelihood akin to what IMF was saying in the past couple of weeks?
Well, we certainly do think that growth beyond this year is going to pick up, but still be materially below what we're used to seeing, probably closer to potential between 1.5% and 1.8% growth. And that's certainly not the 2.5% to 3% growth that we saw before the pandemic. But inflation will be tough to keep down because there are going to be these structural drivers of higher inflation. So that means the Fed will have to keep interest rates higher for longer in order to get inflation back to the 2% target and maintain it there.
What does it say, Dana, that so many people before this period of time said that this economy could not handle higher interest rates, that suddenly we are seeing ongoing growth in the face of interest rates that are the highest they've been going back to the 1980s, and that people believe that the Fed will eventually have to cut, but you're saying not really that much given how much inflation is going to pick up. What does that mean about what the right rate is?
Well, when I look at the economy, different aspects of it are behaving differently. So I use different a lot. So if you look at the housing market, residential investment, that's really come off, and that really moves first when interest rates rise. And then business investment has come off a little bit, and consumers have pulled back on spending on durable goods, which are things that they need to finance. The last shoe to drop really is services. And I think it's going to take some weakness in the labor market or even belief that consumers believing that they might get let go, even though they may not. And that's really going to bring things back into balance.
Dana, one final question. We've got to go to some breaking news here, but Dana Peterson, it's too important. You opened this conversation by talking about sub 2% growth. Can I assume that with sub 2% growth, X% of America is in recession? How big is that part of America that feels recession, even if the GDP statistic is positive?
Well, I think definitely people with lower incomes, because much of their paychecks get eaten up by inflation. But also we're seeing worries among people who have higher incomes, especially the middle class, because they're the ones who pay the most taxes. They also pay a lot of, in terms of inflation, they're still very much affected. And so I think it's those groups that are definitely feeling the pinch right now.
Dana, thank you so much. Dana Peterson with the Conference Board. I guess it's a roll-up, but when a stock, Lisa, goes from 5 to 8 on its way to 5 to 10, with an odd proposal of Boston's Trillium Capital over a name that we in the media know a lot, which is Getty Images. And this is the ownership of not all, but damn near all of the famous photos that we live with each and every day.
Just to bring you what just crossed the headline, Trillium Capital has offered a non-binding proposal to buy Getty Images for $10 per share in cash. This according to a statement that just came out moments ago. You could see Getty shares responding pretty dramatically ahead of the open, up more than 40%. And this comes at a time of a real question of how to generate value from stock images, from media content that people use on a regular basis that becomes just basically part of the framework of what we see. And yet you got to get paid for it.
You got to get paid for it. Tiny company, 100, 200 employees, whatever it is. And what's so important here, like the music copyright, like who owns Taylor Swift songs, just as one example, with these photographs, maybe the revenue growth's a little shaky, but their EBITDA margin down the income statement is Apple-like. It's 30%, 32%. And they're even taking out a net income now of 10 cents on the dollar is modeled out with a positive free cash flow. Elon Musk would love an income statement like that for Twitter. It's not there.
Well, what I find compelling, too, is this idea that a lot of hedge funds and just firms in general, investors, are looking for ways to find incredible value in old companies. And I say old because they really made their mark in a different kind of model for media. How do you get paid? How do you generate capital at a time when people still rely on these images? But are you getting used to getting things for free online?
Yeah, we're going to have to see, and we'll have much more on this. It's a small transaction, but I think it's just emblematic of the ownership of digital product today. They don't own this photo. This was just out on Twitter from Mr. Kawa, who I believe attended Friday as well.
Yeah.
It's birthday for his dog. This is not owned by Getty Images, but maybe they'll want to acquire this. The level of cute here is off the chart. It's Mahavlich, and of course, the beast is named after the great Frank Mahavlich, who not only did hockey, but became a senator in Canada as well. He was, in my youth, Frank Mahavlich was truly one of the best. And Mahavlich is 3 years old today, and we say birthday greetings. And I suggest Getty pick up the rights to this photo.
It's basically an archetype of cuteness. That's the advertising pitch for Getty Images to pick it up.
Yeah. Can you imagine when Luke starts talking bonds and fixed income dynamics? I mean, Mahavlich must just like run. Anyways, happy birthday to Mahavlich the Beast as well. Futures at -6, Dow futures -50. The VIX, again, under 18. I think it's a bull market VIX. We haven't had anybody tell me today that we got a bull market, Lisa. We're at 17.56. Here, is it a bull market? I can't get a straight answer.
It depends which side of the market you're talking about. If you look at big tech, it's been doing really well. If you look at Meta, if you look at NVIDIA, as you mentioned earlier, if you look at some of these companies, they're up more than 70% year to date. If you take a look at the rest of the market weighted, or rather the equal weighted index, not so much, kind of more range bound.
Can we talk about something you mentioned, I think, earlier? Oil under 80? I don't know what to make about that.
Well, yeah, last week was actually a pretty significant decline, and people are expecting a slowdown despite China coming back online.
Bitcoin, same thing with Bitcoin, sliding under 28,000. John never mentions Bitcoin.
No,
what is that about?
He does not find it compelling. I think he just is not as familiar, and it's not a benchmark that most people
He should
look
guest host the crypto show.
Oh, you can let him know that.
He'd be killer at that. Stay with us. Bloomberg Surveillance. Good morning.
Sure, he'll be pleased with taking on another responsibility. Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, possible presidential candidate Ron DeSantis met with Japan's Prime Minister Fumio Kishida in Tokyo. It was a chance for Florida's Republican governor to burnish his foreign policy credentials. DeSantis said he appreciated Japan's efforts to boost its defenses. Japan has increased military spending, in part due to China's threats toward Taiwan. House Republicans want to resume construction of a wall along the border with Mexico to deter migrant crossings. The Homeland Security Committee is set to unveil a bill today. It would require spending for border infrastructure and technology and would boost the Border Patrol from 19,000 agents to 22,000. The foreign minister of Ukraine has made an urgent appeal to the European Union for more military equipment and ammunition. Dmytro Kuleba spoke to EU ministers by video link. He told them there is, quote, no rational arguments why Ukraine can't get modern Western combat aircraft. The CEO of NBC Universal is leaving after admitting to an inappropriate relationship with an employee. In a statement after an investigation, Jeff Shell said he deeply regrets the incident. He served as CEO since January 2020 and worked at NBC Universal parent Comcast for almost 2 decades. A replacement has not been announced. LVMH has become the first European company to have a market value of more than $500 billion. A boom in sales to China and a strong euro have boosted the luxury goods maker. LVMH's rising value has turned CEO Bernard Arnault into the world's richest person. According to the Bloomberg Billionaires Index, he's worth almost $212 billion. Global news 24 hours a day on air and on Bloomberg Originals, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We still like the tech sector because certainly the understanding that there's a lot of inventory to be worked off. The question is, can they have decent results and the markets really go down because of that? We think we'd rather ride that out and say these companies have long-term growth, they have good positions in their industry, strong balance sheets to withstand, even if we do have a deep recession.
Margie Patel, let me take a moment here. She started us off strong on a Monday here. Margie Patel is legendary in every good way at Allspring Global Investments. And I want to explain that this is what Bloomberg Surveillance is about. Lisa, this is someone who does something old and fogey, which is a balanced portfolio But unlike no one I know, she can move from bonds to equities to dividend paying, dividend growth, and back and forth. She is the supplest person I know at actually doing balanced.
And at a time of so much gloom, she's been pretty risk on consistently and actually going more into stocks and even into some of the safer bonds.
But I really just can't say enough about the suppleness there. Speaking of suppleness, this guy leads the way. Rich Greenfield had to wear a flat coat, flat jacket, and a helmet here years ago in media as a sell-side analyst. He was one of the courageous guys out there in a really vicious time for IPOs and secondary offerings and that. He's aged nicely at Lightshed Partners and joins us this morning. Rich, I got to cut to the chase. I've never seen more capital deployed and misallocated in 14 different ways. How bad will the rationalizations of labor be across all of the Rich Greenfield space?
I mean, look, the reality is, we saw a lot of what I would call overhiring during sort of the pandemic, where I think there was just this sort of, incredible surge of activity around a lot of these companies. I mean, obviously they were first depressed for like a nanosecond, and then we just saw this massive explosion in a lot of these digital businesses. And you're seeing a right sizing now. I mean, look at what's happening to companies like Meta and Google, Alphabet, et cetera. But even Netflix and others, I mean, you've seen sort of across the board headcount reductions, not because business is collapsing, but I think more than anything else, Tom, is just that they got a little ahead of themselves in terms of hiring and just brought on too many people relative to overall revenue growth.
Rich, you and your team have been leaders in trying to monitor the consolidation of what we call entertainment. I saw a photo this weekend, folks, of people buying Taylor Swift's merch, and it was like 4 miles long to buy, Taylor Swift T-shirts and coffee mugs and that. Rich, I want to talk about monopsony, or the consolidation here under monopoly and where price is set. Are we just going to have 1 or 2 or 3 entertainment vendors at the end of the day?
I mean, right now, things are pretty amazing for the consumer, Tom. I mean, yes, you have the legacy multi-channel bundle that you and I have been sort of watching melt down over the course of the last 10 to 15 years, what people like to call cord cutting. But we're really in this era now of where the consumer is in the driver's seat. I mean, think about what used to happen in the cable and satellite world. I mean, having to wait, call up to change your service. Someone had to come out, swap out a box. Like, canceling was a pain in the neck. Nobody did it. Now with things, whether it's Netflix or Disney Plus or Paramount Plus or Peacock, all of these things, click of a button, sign up. If you're not happy with your Peacock service, or you're tired of it, or you watched enough content, you literally click cancel, click of a button. There's no waiting for someone to come to your house. I mean, I don't think we've ever been in a better time in entertainment for the consumer than we are right now. More content, and you're in control of what you pay for the first time.
It goes to this kind of frictionless ability that we've been talking about with banking, but also with respect to entertainment. Given those options, does it make sense to you that simply cutting workers, like what we're seeing at Meta, like what we're seeing at Disney, is enough to engender a new era of growth? I'm just wondering, basically, to put it more bluntly, does Meta's cutting of staff justify a 77% gain so far this year?
Absolutely. I mean, when you think about what's happened at Meta, they've, sort of gone back to what they're good at, which is selling ads. I mean, they're one of the best companies in the world for helping small businesses around the world move products off shelves. Like, that is what Meta does. They are incredible at direct response advertising. Nobody does it better than what Meta does. There was a lot of distraction, a lot of focus on the metaverse and virtual reality in the future. And I think Mark very much correctly realized he needed the street support. He needed investors to believe in this story. He can still build his long-term metaverse vision, but he has to do it in line with the growth of the company. And I think that's what got disjointed. He's refocused, reallocated capital more appropriately. And I think the team has never been more focused on selling the core product. And that's, AI-driven content and AI-driven advertising. That's what's making Meta stock work right now.
Does the same kind of thesis hold true for Disney, which is, I believe, cutting about 15% of their staff in the entertainment division? Does it also give the same sort of optimism?
I mean, you don't have the underlying growth at Disney that you do at something like Meta, right? I mean, the Meta story, while it's had amazing growth over the last decade, there's a lot to come. You know, with Disney, the challenge is really threefold, right? We're trying to figure out, what do you do with Hulu? They've got this sort of extra streaming service. Don't know whether the, sort of NBCU news over the weekend changes that process or at all. But you've got Hulu situation. Then you've got, what do you do with ESPN? As Tom pointed out, the cable network business is not exactly a growth business anymore, and sports costs keep going up. So what do you do with ESPN? And then the big problem, honestly, that the two of you, should think about is the Disney content, that engine of growth, that really that is the lifeblood of Disney, really hasn't been working over the last couple of years. Marvel and Lucasfilm don't look as strong. They look a little tired. And the animation crown, I mean, we're all talking about Super Mario Brothers. What was the last time you were talking about a blockbuster Disney animated title? Iger's got a lot of work. He's got a lot of work to do across Disney's businesses. He's obviously incredibly talented, but he's got to figure out all three of those big issues, as well as find a successor in the next 18 months.
Rich Greenfield.
That's not easy.
Comment, Rich Greenfield, on what I saw twice over the weekend was his fondest desire of Tim Cook to the rescue. And it can be Apple Disney, Apple this, Apple that, whatever. But in your world, there seems to be this savior transaction for troubled companies that Apple would buy you. Why would Apple buy any of this stuff?
Tom, I don't know. I mean, why would you want to own cable networks that are disappearing? Why would you want to own all of these assets when Apple has enough capital? They can make movies, they can make TV shows, they can hire the best talent. They essentially, if they want to become HBO over the next decade plus, they can spend and get there. I think it'd be very hard to imagine them buying a big media company. Sure, would they love to potentially own a studio if you could just buy a studio? But every one of these companies comes with so many other assets. I mean, they have MLS now on Apple TV Plus. Do you need to buy ESPN and have cable subscribers to get? I mean, just buy the good stuff, buy the actual content or invest in it, build it. I don't think you have to go out and buy one of these companies. And I think your point is well taken, Tom. Way too often in this space, it's like, oh, I can't figure out a growth strategy. Maybe we'll just get bought by Apple or Amazon because they have so much capital to deploy.
Rich, 20 seconds, your single best buy right now at Lightshed Partners.
I mean, I think, look, it's when you think about recovery stocks right now, the two that stand out that are sort of rebounding off of their lows, I think you would probably put both Spotify and Snapchat right now.
Very good. Rich Greenfield, thank you so much on entertainment. Just a great snapshot there as well. One of the big surprises here at Bloomberg is we are doing digital experiments. And Lisa, the first glow of your newsletter coming out, I didn't expect this. It's like 42 people have signed up. It's amazing how that works.
Are you calling me a digital experiment? Thank you,
You're
Tom.
a digital experiment.
If you want to sign up for this surveillance newsletter, it does come out and you can sign
Daily.
up. Bloomberg.com/surveillance. Look, this is a really, we have all these conversations and you think about how many themes people kind of play off each other. And it's great to get a sense of the great nuggets that people really parse through every day.
Let me translate the marketing babble you just heard from Bramo. It's real simple. This thing is worth looking at because of the click-throughs. The click-throughs are off the chart. Most newsletters are ego, 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 ego. You don't do that. It's like, here's what we talked about today on the show. How many click-throughs do you typically have in a newsletter?
I haven't gotten
8, 10, 12. You got
pretty small, yeah.
No, I think that's great. They're focused and great, and that's the power.
People definitely want to hear the interviews. It's sort of what makes
surveillance
great.
newsletter. It's a Bramo. It's a Bramo effort as well.
It's a group effort.
We can stop the show now. Futures are flat. Good morning. This is Bloomberg.